Can you hear me? You hear me now. Thank you very much. I'd like to call this informational hearing of the Senate Banking and Finance Institutions Committee to order. And I want to welcome Mr. Ben Wesso, Senator Wesso here, and others that will be coming in and out as we progress during the hearing. Know that we are being, I guess, what is it, televised, live, webcast? Live streamed, that's okay. And I'm excited this morning to look at some very familiar topics from a different perspective. Typically in the legislature we talk about unsecured loans, payday loans, lending that is, and installment loans by the California finance lender dominated conversation, so to speak. But today what we're going to do is, again, not talk about payday loans or unsecured lending, but rather we're going to talk about depository loans, nonprofit loans, and unlicensed loans, three groups that we really haven't had the opportunity to address in this committee. We'll begin by hearing and listening to witnesses from credit unions and nonprofits, essentially two groups that are financed through philanthropy. And then we'll talk about the types of unsecured loans that they're making, the terms that they're offering, the type of underwriting they require, and how popular those loans are. And of course, what kind of rates they offer. These two groups will also talk about the challenges they're facing in the state of California as they try to roll out their products. And more importantly, at least for this committee, is we're going to find out if there's any changes to the California law that are needed to make their jobs much more successful. Then we're going to hear from another group of lenders that are lending in California without a California license. And it is an important group to engage because they'll help us understand the elements of California law, the law structure in California that discourage these businesses from becoming licensed in the state of California. And of course, we will also hear from California's regulators about their efforts, especially from Commissioner Owen and her efforts to address this unlicensed lending in the state of California. And her efforts to assure that all the loans that are being made in California are actually produced by a licensed lender. And then finally, of course, we're going to conclude today with a public comment time period so that all of those in the audience that wish to address this body may have the opportunity to do so. Before I start and call our first witnesses, I'd like to have Senator Wesso, if he so wishes, make a few comments to the committee.
Just briefly, I wanted to thank the, does this work here? Can you hear me? No? No?
Hit both buttons. You got both buttons lit up?
Well, there you go. Thank you very much. Thank you, Mr. Chair. Just want to thank you for having this session. It's my pleasure to be a part of it. I've always believed, and I always tell people that lending is the key to creating an innovation economy, putting capital in the hands of especially small business people with new ideas that give them the opportunity to bring their ideas and their business plan to the market. It just adds to the diversity of services that we can offer the people in our community, and I always thank the banking institutions for thinking out of the box and reaching out to the small business community. And I always believe that there's more that we can do. I think the future of our economy, the vibrancy of our economy, the strength of the fabric of our economy is really in the hands of the financial lenders who make capital available to the best business plans in our community so that they can bring those products to the market. And of course, it's all part of the American dream, right? Getting people access to the American dream and achieving their financial goals and their their vision for their own improvement. So this this issue is that we're going to discuss today is very important to our community. I look forward to hearing from all the presenters in terms of what they have to say on this issue.
Thank you, Senator Wessel. And your comments remind me to underline really the goal of this hearing. And I'll do that by a very brief story, which is my own. I remember when I was growing up, being part of a family of new immigrants to this great country, first TV we had, we actually rented. And we paid that on a weekly basis. And I remember the first installment loan my mom got in those days. I think the interest rate was probably appropriate for our risk at that time. But the point is that those are the first steps in trying to become part of the economic financial system of this country. Very important steps as I look back. Today, the reason for this hearing is to make sure that those options for those folks that are looking to establish credit, for those that are socioeconomically struggling in this great state, that they have the opportunity to begin to build credit and move up. So again, keep those thoughts in mind as you move through the testimony. And if I can, I'd like to have our first set of panelists come up. President of Self-Help Federal Credit Union, Mr. Steve Zuckerman. Welcome, sir. And representatives from Travis Credit Union, Sherry Cordonier and Stacy Fifield. And for the Center for Community Economic Development, Ms. Amy Chitayat. My apologies if I mispronounce your names. Welcome. And I've been asked permission for photographers to come up and take photos. Absolutely. Welcome, come in and take some good photos. You may begin.
Would you prefer here?
Yes, Steve, if you can please start.
Can you hear?
Yes,
There
we
go.
can hear
All
you
right,
really
there
well.
go. Chairman Correa, other members of the committee, thank you for including us and giving us the chance to share a little bit about what we do. By way of background, I manage all the California operations for Self-Help, which is a national community development financial institution. And our particular mission is to serve those often overlooked by the financial mainstream, including low-income and minority families and communities. Since we were formed in 1980, we've invested more than $6 billion in about 70,000 families, individuals, businesses, and nonprofits. And then I launched our California efforts with an office in Oakland in 2006. So the California piece of what Self-Help does is a relatively new effort for us. I've been asked to talk about the particularly consumer lending that we do, and I'll do that in a minute. But I thought it might be helpful to provide a little bit more background on what our operations in California are, so you have the context of how and where we do that lending. In 2008, we created Self-Help Federal Credit Union as a federally chartered credit union by NCUA, and we did so specifically. Self-Help actually manages another credit union, a state-chartered credit union in North Carolina, but we created a new credit union because we thought it would better serve the needs and interests of California, where we were going to be focusing our attention. And as the introduction said, I serve as president of that credit union. We really created Self-Help Federal to serve lower-income communities in California for two primary reasons. One was that we saw in the beginning years of the recession that a lot of the smaller credit unions, particularly those that were serving lower-income communities, were facing financial struggles. And credit unions, unlike banks, have less ability to raise capital when they get in trouble. So if they have financial struggles, generally the regulators have two options. They can either insist that the credit union close operations or merge into another credit union. And so we felt that if credit unions that were serving low-income communities were going to be faced with the prospect of merger, it would be great if there was a credit union that was really dedicated to serving low-income communities where they could land. The second reason was we saw, even though we had been serving lower income communities through...
Sounds like a model of acquisition.
Merger, in credit union land, it's mergers, and yes, it
Okay,
was
so it's merger.
to be a place where credit unions that wanted or needed to merge, because there's no economic outside ownership, the idea of acquiring someone who doesn't want to be acquired really doesn't come into play. A credit union has to essentially offer itself or be told by the regulator to offer itself for merger in order for there to be an opportunity.
Thank you.
The second piece of why we created the credit union was that we hoped to try to help develop new models for how lower income communities could be effectively served. We had been serving low income communities through traditional credit unions, but we saw the growth of what is now often called the alternative financial services sector, check cashers and the like, that were increasingly serving a population that wasn't using banks, wasn't using credit unions. And so we developed what we call a hybrid model, a credit union branch that actually looks a lot like a check casher and provides check cashing services, remittance services, bill pay services, very much like a check casher. But then also alongside that offers the traditional credit union products and services, deposit accounts, lending accounts. And we like to say that the goal of that model was to meet customers where they are, not ask them to change their behavior to work with a credit union, but to continue to be able to do what it was that they wanted to do, but to then do it in a place where they had a migration path into the financial mainstream, not within an institution that only offered those alternative financial services. So, fast forward 5 years, we have absorbed the operations of 7 relatively small credit unions through merger, or in a couple of cases where the NCUA actually closed.
Let me
it.
interrupt you, and you said you were moving towards positioning yourselves where these folks who typically did business. Are you talking about physically setting up shop in a place that they're familiar with, the supermarket, the corner store, the liquor store? Is that what you're talking about essentially?
Exactly. So our pilot branch, kind of our experimental pilot branch, was in East San Jose, in a strip mall, right next to a 7-Eleven, across the street from 2 check cashers. So along a transit corridor in the center of East San Jose. So we did try to put it where that target customer was doing their business, living their life, going from home to work, et cetera. We subsequently, last year, actually purchased 5 check cashing stores in the San Gabriel Valley outside of LA, where we have now converted what were operating ongoing check cashing stores serving check cashing customers by definition, and have now converted those locations to this hybrid model, which we call CT Prospera.
When you say you purchased these check, did you actually purchase the business, meaning you purchased the goodwill, or did you just buy the lease of the building, the brick and mortar? What did you do? You took over?
We basically took over the lease and essentially paid a small amount for the customer base. So we didn't, there were no real assets to purchase. So in a sense, we bought the goodwill, the value of the customer base, fortunately for a fairly modest amount.
So you were able to keep those customers, so to speak?
We for the most part, we have. I mean, we're only a little over a year into that process, less than a year since we were able to fully convert the computer systems and operating systems to offer the full product suite.
So you got a person who would typically just cash a check and now said, by the way, do you want to open up a deposit account or offer or take advantage of the other products? Is that essentially the model?
Exactly right. And to try to do so in a kind of a non-judgmental way, to not say, hey, you used to do this, now you really should do this, but rather, this is the 3rd time you've come in and you've paid $15 in check cashing fees. We have an account that's got a $3 a month fee, and if you deposit and use the money as you go and you get a debit card with that, would you like to do that? If they say no, we say, okay, we'll keep cashing your check, and it's maybe the 2nd, 3rd, 4th, 5th time they come in that they may entertain.
You said you lost, for the most part, you get most of those customers. Those that you lost because?
I can't honestly tell you. We don't have
Speculate for me, just.
Our understanding from when we studied the check cashing business is people will frequently use more than one location anyway, so to lose a customer, not quite sure what that means.
Okay.
But we don't know of anybody who has said, wow, we used to cash our check at a check casher, and now you're a credit union, we don't want to cash our check there. Again, we've tried to keep the look and feel close enough to what they were used to that it wasn't a jarring transition.
Thank you.
I mentioned the launch of the hybrid model.
Another quick question for you, which is Eileen here, my consultant. Good point, which is how many of those folks that were just doing check cashing for $15 made the move to the other products, meaning, deposit, your debit card, and by the way,
Yeah.
now you only get charged $3 per check that you cash.
As I said, we're very early in the LA experiment. In San Jose, where we've been operating longer, about, I think the number right now is 23% of our total clientele has opened an account of some kind. So that's the real data we have. We have not yet really, as I said, we only introduced accounts in February of this year in the operations in Los Angeles. And because we've just been stabilizing operations, we haven't done a big marketing push yet, and I don't have data on how many people have actually opened accounts that previously were just check cashing customers.
Please continue.
All right. Today, Self-Help Federal operates 17 branches in California, in the Bay Area, the Central Valley, the San Gabriel Valley. We serve about 50,000 members and clients. And the more traditional branches, those that were merged branches that had operated as credit union before, those operate under the brand of Community Trust, a division of Self-Help Federal Credit Union. And the hybrid branches operate under the brand of CT Prospera, a division of Self-Help Federal Credit Union. I mention that just so that for those of you who are out in the community, you might say, well, I've never seen a Self-Help Federal Credit Union branch. We haven't branded under that name, so you may have seen the Community Trust brand or the Prospera brand. So we were specifically asked to talk about lending. Like most credit unions, we offer a lot of different loan products. Given our mission, we try to structure our loan products and processes so that they are welcoming and available to people who might not have the best credit. That's our particular goal. We obviously can't serve everybody, but we make that effort. We're just to be clear, the fact that we try to stretch who we can lend to does not mean we don't use rigorous underwriting. We still very much believe that the goal is to lend to the people who have a demonstrated ability to repay. We just want to try to work a little more creatively and a little harder to figure out who some of those people who may not have good credit scores, but actually do have a good ability to repay. And that's our goal in all of our lending. Was asked to talk about some of the consumer loans, particularly unsecured consumer loans. An unsecured signature loan is sort of a staple product for most credit unions. In our case, we have loans that are available in increments from $250 to $10,000. Most of our unsecured loans are under $5,000, and about a third of them are under $1,000.
What is the interest rate you charge on those?
It's a variable rate. The average interest rate on our portfolio originated year-to-date has been 14%. The max is 18% by credit union statute.
What's the lowest rate?
On the consumer loan, I think we go down as low as about 5.5% for a very strong credit.
Because it's risk-weighted then?
Yeah, it's risk-weighted, it's amount-weighted. It's sort of a graded scale based on the amount of the loan, the underwriting characteristics of the particular borrower, which is influenced but not exclusively by credit score, and then also the term.
What is the average length, or do you have an average length on the amount of the loan?
I believe that we offer unsecured signature loans as short as 6 months, though most are at least a year, and I believe they go up as long as 5 years.
Do you look more at their income versus expenses, or their assets, or both?
Mostly income and expenses, we're not going to lend strictly against assets where, we say, well, we don't know if they can repay, but if they don't, there's something we can grab. That's
It'd
not.
be more of a hard money loan.
Exactly.
Yeah. Now, let me ask, if you got folks that are, in this very difficult economic environment, struggling to survive, so you got folks that probably their income probably just maybe covers their monthly expenses, so the ratio there would be just, difficult to make a loan on?
That's true, yeah. That if
If I came in, you looked at my expenses versus my income, you look at a ratio of 40, 50?
It's different for different products. We have some products where we will go as high as a 50% DTI, back-end debt to income, so where planned and scheduled expenses are no more than 50% of gross income. Most of our products are a little lower than that. They're in the low to mid 40% range. It depends. Again, in mortgage lending, where you have larger loans and the ability to do more work and do more digging because of the size of the loan, we will also look at just residual income as a factor as well, the absolute dollars that someone has as a safety net after paying all of their required expenses.
Thank you.
Okay. Year to date, and I just pulled numbers from this year, we've made just about 500 loans through our traditional unsecured signature loan. Average size is an average balance of $2,400. I mentioned the interest rate. And I'll mention that more than 40% of those borrowers had no credit score. So we were able to do the underwriting on someone's actual information, even though they were not part of the financial mainstream and the debt market long enough to have developed a credit score with the rating agencies. And that's the kind of lending we really try to do as much as we can, where we're serving people who, if they just came in and said, need a credit score of 640 or above, or 620 or 580, whatever the number is, we're trying to serve people who don't fit into that bucket.
So do you report the credit history to the credit agencies of these folks that?
We do.
Do you make money?
We do.
Okay.
I will say, if these small loans were all we did and had to support the full cost of a brick and mortar credit union, then no, we probably would not make money. But with the portfolio of lending we do, with auto loans, which are larger and stay on the books longer, with mortgage loans, which are still larger and stay on the books, we don't happen in California to do a lot of commercial lending yet. But yes, Self-Help Federal Credit Union is profitable, and
So if you don't make money off these small ones, then why do it?
because it serves the community. There's a real need out there, and our goal is to be able to do that without losing a lot of
Well, it
money.
serves the community, but let me ask you, do you get an economic benefit, say that these folks in a couple of years will probably be taking out an auto loan or a bigger loan, so therefore what you're really doing is investing, instead of going out there and spending a bunch of money on TV ads, what you're doing is really investing, sort of subsidizing those smaller loans on the hope that they'll eventually take out a bigger loan through you.
Absolutely.
I mean, is that part of the bigger picture?
It is. I mean, it's one of the reasons why we want to invest in folks who are getting themselves onto the path toward economic prosperity and help them on that path. And we certainly hope that if we are part of what helps them get there, that they then remember that and are inclined to do business with us later. We have not tried to quantify that, don't know how well we could quantify that, but it absolutely is a hope and part of why we do what we do. And we also believe that there's some level at which financial institutions that benefit from deposit insurance, which gives us a low cost of capital, does things that are good for the community, even if we can't quantify the immediate economic benefit. We just have to be careful how much of that we do and that the whole system works in the long run.
You've been in business here in California for how many years?
In for a little over 5.
Have you gone through any process of changing the way you do business, your loan structure, the loans that you offer?
So as I mentioned, a lot of our credit union operations were our absorbing operations that have been serving communities in California for, since the 30s. And we have consolidated and tried to standardize how we do lending, and we have actually changed policies to try to serve less well-served people more actively, and we're constantly evolving. We're trying to develop new products all the time to meet other needs in the marketplace as best we can. So what we do is evolving all the time.
The California laws, they help or hurt?
So as far as a credit union, we operate under a federal charter. So those are it's the federal credit union laws that govern most of what we do. I think in terms of California laws, the impact is on the landscape that the California lending laws create in which we operate. So I think that's where California laws impact us, not directly but indirectly by creating the marketplace or influencing the marketplace.
California laws, how do they influence you, positively or negatively?
So, I think the biggest thing for us, and I was gonna sort of tell a little story of won't use a real name, but a prospective borrower that comes into our branch, and they tell us that they've got a short-term or a medium-term need. They've got a little gap between their income and their expenses, and they'd like a loan, and we describe to them our unsecured loan, $500 loan. It's a fairly simple 2-page application. We should be able to get them an answer within, if not a couple of hours, certainly 24 hours. And they thank the loan officer and say, you know what, I'm going to go down the street because I can get $300 and I can get it right now and I don't have to fill out an application at all. We never know whether that person would have qualified for a loan for which they would have paid a $50 monthly payment, paid the loan off in 6 months, had total cost of borrowing of maybe $50 or $60. And if the statistics hold, that person probably did get the $300 loan, paid $45 for it, then paid $45 9 more times, and ended up spending $450 to have the use of $255 when they could have had a loan that would have served their long-term economic interests far better. So I think what impacts us is that when there are very short-term, convenient, attractive loan opportunities that are only available, they're only that convenient because the lenders have an economic model that doesn't require underwriting, doesn't require them to determine the ability to repay, which means they don't have to do the work that an application and a little bit of time.
So is that a
requires.
regulatory issue, more of an economic, the way you do business kind of an issue?
Well, it's a regulatory issue in terms of allowing lending that has 400% interest rates and is a seductive loan. I know this is not a hearing about payday, so I don't want to get dragged into that debate. But at the end of the day,
But
that's
what I'm trying to
that's what it
ask
is.
really is how to make you more competitive, so to speak. If you've got you've got different options as a borrower, that option versus your option, yet it sounds like that's a battle you didn't win. I'm trying to, not looking at them, but looking at you, how can you win that battle?
Yeah, and I think at some level, we can't. We can't in the marketplace because we're at a competitive disadvantage because of the regulatory environment that we are not willing to do a kind of lending that we think is destructive to people more than it's helpful, but the regulatory environment allows other people to do that. And as long as it does, we'll never win the competitive battle. We just won't.
Thank you. continue, or?
I feel like we're taking a little too much of the time here. I can talk a little more about some of the other lending we do. We do a lot, but if that gives you what you're looking for, I'm happy to pass the mic.
Thank you very much. We'll
Okay.
move ahead to our next presenters from Travis Credit Union. But before we do that, what I wanted to do is have Senator Vidak say a few words, if you so wish to the committee.
Glad to be here, and this is going to be very interesting for me. This is
Welcome, sir.
important to my district.
Sorry, go ahead, the next presenter.
Mr. Chair and Senators, Rodney Wilson with the California Credit Union League. With me today, I have Stacy Fifield, Senior Vice President and Chief Lending Officer of Travis Credit Union, and Sherry Cordonera, Director of Corporate Relations for Travis Credit Union, who will be testifying to the committee on one of their innovative loan products.
Welcome. You can actually move those closer if you would like.
Don't think I'm long enough. Good morning, Mr. Chair and members. My name is Sherry Cordonier. I'm the Director of Corporate Relations at Travis Credit Union, and I'm here with my colleague Stacy Fifield, who is the Senior Vice President and Chief Lending Officer from Travis Credit Union. She'll assist me today with any technical questions that the committee may have about my testimony today. Thank you for the opportunity to speak today about small dollar lending in the credit union industry and highlight a specific new and all-encompassing program being piloted at Travis Credit Union. Currently, Travis Credit Union is the 12th largest credit union in California with more than 180,000 members and more than $2.2 billion in assets. Travis Credit Union was founded as a federally chartered credit union in 1951 to serve the military and civilian personnel associated with Travis Air Force Base in Fairfield. Today, we are a community chartered credit union. By the end of its first year, the credit union had 72 members with $2,271 in assets. Today, Travis Credit Union is one of the leading financial institutions in Solano, Merced, Yolo, Napa, and Contra Costa counties, and it's among the top 100 credit unions in the country when ranked by assets. In August of this year, the Credit Union National Association's Lending Council produced a study for credit unions about unsecured lending in a very crowded marketplace. Some of the takeaways from the white paper included many lending professionals believe credit cards have taken over the small loan market, but the American consumer is wary of taking on more debt and wants to pay down expensive credit card debt. Consolidation loans to pay down this type of debt are growing in popularity. Payday loan customers are a small subset of the credit union membership, typically 1% to 2%. They frequently pass on financial counseling and want their funds immediately. The study also found that members receiving these loans will likely come back to the credit union for more services if the experience was positive. If individuals, particularly in the payday loan cycle, could build the savings to avoid frequent personal financial crises, or could develop a credit history making them eligible for lower cost resources of credit, they could free themselves from dependence on payday lenders. And given the modest incomes of most payday loan customers, saving $500 to $1,000 in annual finance charges could make significant changes in their quality of life. Travis Credit Union was faced with those facts, and even more glaring are the statistics about the underserved Latino market and Latino community, financial literacy, and small dollar lending. Deeply embedded in the credit union tradition is an ongoing search for better ways to understand and serve credit union members and the general public. Our credit union searched for a solution and came up with what we believe is an innovative approach to small dollar lending in the underbanked community called the New Era Tanda program. This pilot program debuted in mid-2012, in part through a grant received by the National Credit Union Foundation. The New Era Tanda program goes far beyond just small dollar loans.
What is the name of that program?
New Era Tanda.
Tanda.
The program was designed to help Latino participants develop a 12-month shared savings goal and to take advantage of the credit union's unique savings and loan offerings. We developed the program concept for this unique program centered on tandas, also known as pudinas, sans, and quinielas. Tandas, informal borrowing lending circles, are common in immigrant cultures, especially Latin American immigrant cultures. The modernized tanda developed by Travis Credit Union aimed at bridging a cultural custom with the credit union experience. Travis Credit Union partnered with the YOLO Family Resource Center to conduct the pilot program. The program used a grassroots and culturally relevant approach tailored to the local Latino community. The first New Era Tanda program class was composed of 6 individuals, each of whom was encouraged to attend monthly financial literacy courses, all offered in Spanish. Participants contributed on a monthly basis to a shared savings account and also received a group share secured loan to help save for a down payment on a vehicle. In addition, after satisfactory completion of the program, each qualified participant was eligible for a Travis Credit Union credit building credit card and/or an auto loan.
So the tanda itself, is that their experience in the tanda, is that reported to the credit agencies?
Yes, it is.
Okay. So you're taking something, and I've heard of this in the communities. Typically what you do is everybody kicks in $100 a month, and each one of those participants in that, say, 10-person circle gets the $1,000 each month respectively, and everybody kind of kicks in for 10 months, 100, and so on and so forth. What you're doing is essentially formalizing the process by making sure that there are records, so to speak, and there's accountability, so to speak, so that then you can report this to a credit agency, and there you begin to build a credit. Is that what we're hearing here?
That is correct, yes.
And how do you make fees, commission, income off of this process?
This was a share secured loan, so the loan interest rate was 3% above what we were paying on our shares, which is 5 basis points today. And it just really taught the participants what the additional fee was for interest, and they got their statement every month, and we were really educating them along the way, and taught them about insurance products and the importance of having car insurance and whatnot.
So your interest is about 3.05%.
Correct, for 12 months. So they made 12 payments, they made 12 deposits. So by the end of the year, they each had $1,200.
Okay. Thank you. You may continue.
Throughout the program, participants and their families were encouraged to discuss how the various financial education topics in the act of habitual savings affected their financial well-being. After graduating from the program in August, qualified participants became eligible for Travis Credit Union's individual product offerings to meet their credit building and/or vehicle purchase goals. As with any good pilot, measuring the results was incredibly important to Travis Credit Union and the National Credit Union Foundation. Travis Credit Union worked to create pre- and post surveys to measure and track the change in each participant's financial beliefs and behaviors. These surveys were administered at the launch of the program and at the end of the program. One of the goals of the program was to build Hispanic members' credit and good financial habits through financial education. Additionally, I might like to add is that we also wanted to educate these individuals about how to do banking in the United States. Many of them had absolutely no idea of how to make a transaction. They basically came in and they did what someone else told them to do prior to this. Participants were more likely, after participating in the program, to use online banking, bill pay, checking accounts, ATM debit cards, credit cards, savings accounts, and direct deposit when they were after the program graduation. They were also more likely to do the following. They balanced a checkbook. They could cash checks and know exactly whether there was a fee or there wasn't a fee. They could use a personal budget. And after completing the program, participants increased their knowledge of credit and credit scores from basically having no knowledge to understanding what a FICO score is and how to read a credit report and how to dispute an error. The pilot program was a success that will hopefully be replicated in the future at Travis Credit Union and other credit unions across the nation.
Thank you.
Welcome.
Questions from the committee? Thank you very much. We'll go on to our next presenter, Ms. Amy
Chitayat.
Chitaya, thank you, with the Center for Community Economic Development. Welcome.
Thank you. Good morning, Chairman Correa and committee members. My name is Amy Chitayat, and I am a program director with the Insight Center for Community Economic Development. And we're a national nonprofit organization dedicated to building economic health in vulnerable communities. For the past year or so, I've been researching what it would take to get more mainstream financial institutions to offer responsible small dollar loans to consumers with limited or poor credit as an alternative to payday loans. I think that credit unions will be the proving ground for widely available, responsible small dollar loans. They are an ideal alternative lender because of their nonprofit mission, national scale, and proactive membership engagement. Now, mission-driven credit unions are increasingly interested in providing alternatives in the wake of the recession and the explosion of consumer indebtedness, and a number of small dollar loan models are now being tested. These models try to find a balance between the needs of the financial institution and their low and moderate income consumers. However, the majority of credit unions still need to catch up. Their limited enthusiasm typically comes from their concern about the return on investment, misinformation about the type of borrowers that need such loans and the risk involved, and a lack of staff capacity for startup and implementation. It seems clear to me that scaling up alternatives is dependent on both designing an effective model, and there's been a lot of attention on that lately, as well as on mobilizing the incentives necessary to ensure early stage and broad credit union adoption. And I think there's been less focus on that issue. So I've been asked to share a bit of my research into credit union alternatives in other states in order to see what lessons there might be for California. By far the most successful example of wide-scale credit union adoption of small dollar loan products is a product called Better Choice in Pennsylvania. Better Choice is offered in 72 credit unions in 206 locations throughout the state, and more than 65,000 loans have been made since it began in 2006. It is a 3-month installment loan of up to $500, 18% APR, a $20 origination fee, and a requirement that 10% of the loan be held in a savings account. Loan repayment is reported to the credit agencies. But what's very exciting and interesting about this is that there's no underwriting or credit reports. The borrower just needs to show proof of income and be a credit union member in good standing for at least 2 months. Before the 2-month membership requirement was put in place, it started out without that, their loan losses averaged around 8%. With the requirement of the 2-month membership and improved collections, their losses are now at about 4.5% on average. Overall, the credit unions generally break even or slightly ahead, not counting their own staff time because their staff are already there anyway. So here's a model that's out there. But what makes Better Choice different from many of the other models out there is that is its scale. And I think the reason why there is such scale is because there were political and financial incentives to getting the credit unions up and running. The Pennsylvania Credit Union Association traded in on its good relationship with its credit union members to ask for their participation. The association provided model design, training, and marketing support. The state treasurer made a direct plea to the credit unions for their participation, and I think this was key, and offered to pay for 50% of the loan losses if enough credit unions participated in the first year. So they were incentivizing wide-scale adoption with those loan loss reserves.
What do you mean they're 50% of the loan losses, the treasurer would pay?
The treasurer would pay.
From?
So the way it goes is the loan losses were paid through a portion of the interest on a state deposit of $20 million and later $30 million, which was managed by the association.
So state money, 20 million deposit, the interest rate would go
A
to...
portion of that interest was what was used for the loan loss reserves.
Okay.
Okay. After 3 years, the loan loss reserves were withdrawn entirely. But the credit unions continued to offer Better Choice loans following their reassuring experience in the first few years. And so the initial investment helped everyone get up and running, and then once they were comfortable with the loan product, the investment was able to disappear. A credit union product with similar lending terms to Better Choice would only cost borrowers $31 in fees and interest for a $375 loan, which is the average payday loan size. In comparison, the same size payday loan costs about $338 in fees over a 3-month period, assuming that borrowers turn over the loan because they cannot pay it back. And of course, the average repayment time for a payday loan is 5 months. If we were to use the 5-month amount, it would be an even starker contrast of $520.
Sounds like an interesting, intriguing way of doing business. Have you approached any California regulators about doing something similar in the state of California?
I've thought about it. And that's exactly why I was going to actually
Beyond the
talk
thought
about
process of you,
that. Excuse me?
so you thought about it, but you actually have not.
We haven't.
Is this your first time kind of talking about it to a state agency or body?
Yes, it is.
Thank you.
There's no reason why a similar model to Better Choice couldn't work here in California, with perhaps some adjustments to reflect California's needs, values, and culture. An initial investment in loan loss reserves for several years can help mobilize credit unions to take the plunge. If we are to estimate conservatively that California would have 8% in losses, almost twice that of Better Choice right now, less than $1 million would be needed annually over a period of maybe 3 years, but maybe longer, I'm not sure, to insure 60,000 loans at $375 for 50% of their losses, using the same terms as Better Choice. The right people would need to ask credit unions to participate, and those people include legislators, regulators, advocates, the Credit Union League, and so on. And I think that's been a really key
Let
element
me ask
in
you, on
Pennsylvania.
that product you're describing, what are the loss experiences you have?
Yeah, it started out at 8%, and then when they instituted a membership requirement of 2 months and did better collections, it went down to 4.5% on average.
It's 4.5% default.
4.5%. Yeah,
And you have no underwriting.
no underwriting.
Okay.
The volume of the loans went down though, right? There was less loans once you had to have two months in.
Did you have people drop out?
I don't know that, actually.
Okay.
Well, I'm thinking about it now, and I'm thinking they had 60,000 loans over a period of around 7 years. They've got 11,000 loans right now per year, so I'm thinking not, that it didn't go down. Okay, so to address capacity challenges, an intermediary would need to help design and test the model and create an off-the-shelf product and a training program. Finally, the right messages would need to be shared, ones that emphasize mission.
If you'll excuse me, Senator Wesley, have a thought?
You know, as you're making those thoughts, I just wanted to ask, have you looked at the CalCap program here at the state? Because it
No.
has a very similar, I mean, you're describing the CalCap program. And I passed a bill last year that did exactly what you're saying. And it gave a portfolio product that is a loan product up to $1 million that could be administered by private banks and offer this program to the general public. I have found that although it's a much better program than the previous CalCap program that pretty much earned a very bad reputation for not working very well, I thought working with the banking community, we solved all these problems. Yet, nobody out there is really offering this program. And it's been, I've been very disappointed that we have a very competitive program that's not being employed in our state, that's doing exactly what you're saying. So while you're saying, well, why don't we do something like this, you're not aware of it, I really encourage you to look at it, because it might be something that you can offer your members and use deposits that we have here in the state that we have leveraged for the benefit of putting that money out into the community in the needy hands of businesses that don't necessarily qualify for the conventional loan.
And following up on Senator West's wonderful thoughts, let me reiterate that, the goal of this hearing is really to ask all of you, what is it that we need to do to help you stimulate some of that loan activity? Is there something we can do to change the legal framework? The economics, I think, we're going to leave up to you. Let the invisible hand of the marketplace, so to speak, dictate where you want to go, where that capital needs to go. If there's a different way of doing this, love to see it. You got the credit unions here. You have the Credit Union League. What is it that we can do to help you move in the direction that you're moving? You've got some great products. Is there a different way to do this? An innovative way to get folks to my opinion, what I've seen, the big challenge for a lot of folks is establishing credit, having that credit record. And I started out with my story that my mom, our first television, we rented, and our first installment loan, I remember those days. That's the way you establish credit. And I'm saying, how do we move to get folks in our society to begin to establish credit? I don't know how you move people from, immediately going to get a quick loan versus waiting 24, 48 hours or a week to get, pass, your underwriting requirements. You're addressing human behavior more than anything else. How can I get somebody to, not have to get the money in 6 hours versus wait a week? But how, the second issue, which is establishing the environment for all of you to make some very competitive loans, that's what I want to focus on.
And I just wanted to respond to the question about CalCap, and I'm not aware of that program. I do think that the devil is always in the details, but I also think that, as I started out my comments by saying, I think that credit unions are really in a more unique position to offer this kind of loan because of their nonprofit mission and their dedication to the community. In terms of what you're saying, what can you do? I do think there are political as well as financial incentives that can be made. For example, a request from legislators for credit unions to do this would be helpful. Some sort of deposit that could support some loan loss reserves could be very helpful and have very low impact, because it's simply depositing with slightly lower interest rates into a financial institution that's dedicated to providing those loan loss reserves. So it's not an investment of state general fund resources. It's simply, where are you putting your money?
It's a different sort of subsidization.
Yes.
Is what you're looking at.
Yeah.
But ultimately, it sounds like what you're saying is that type of subsidization will not necessarily expose taxpayer dollars to any loss, because you're looking at really the interest rate differential
The interest rate
to be
differential,
what
right.
really makes that program work.
And it's not, of course, the only place that those loan loss reserves could be come up with. I mean, we're talking about, I don't know how much the goal is, but if, let's say, you're talking about 60,000 loans, $1 million could be found from other sources, but that would require some work. So I also just think that the right messages need to be delivered by the right people. And so messages that emphasize mission delivered by regulators, I think, has a very important impact. And of course, there's the types of messages that can be delivered by peers, such as membership, retention benefits, experiences with risk and whatnot. And so I just want to reiterate, I think the combination of the loan loss reserves, the political messages, and something that addresses capacity by having a standardized model and the right messages, I think, are the ingredients that I'm learning are really important. Now, I just wanted to mention a couple of other little things. One is that the Dodd-Frank Act has a couple of provisions that support small dollar lending through grants and loan loss reserves for mainstream financial institutions, but they were never appropriated. Appropriations might go more smoothly with a proven successful model in California, and I have spoken to some people about that who really encourage California to take something on. The last thing that I wanted to mention is that I don't think that a small dollar loan alternative offered by a credit union is going to eradicate the payday lending industry. But I do think they are an important part of a larger set of strategies to nurture and protect the economic security of Californians. Other key strategies that need to be put in place include policies that restrict payday lending, consumer financial education, wages that allow people to meet their basic needs, and asset building opportunities. Thank you.
Thank you very much, and again, if I can throw in a couple of additional comments. As I look at the economic environment in my community, and it's interesting going into the supermarkets now, I see different kinds of outlets, so to speak. Right next to the cash checking booth is another lending institution booth, 2 or 3 now. So you can, send your remittance outside the country, you can cash your check, or you can get a loan. And I've often stopped to observe and watch the application process of some of these folks. And I recognize the lending institutions making the loans because they've been subject to our legislation here. So it's interesting to watch. There is a slow, but I believe real change in human behavior happening. And I think the credit unions could be a big part of it. But again, we're here to facilitate. I'm not here to restrict, but rather to enable folks like you to be able to capture more market share, if I may use those terms.
I do think that a lot of consumers using some of these loan products, these fringe products, aren't aware that the average consumer rolls over a loan 8 times and pays $520 in fees. I think that they may think they're the exception, but I think that some sort of education, an education campaign could really help.
These products have different characteristics, and I think depending on what you need, your immediate needs are. And I think that's really the issue. And ultimately, like you said, how you create wealth building. I mean, where do you take that $10, $20 a month that you may have left over and you start building it up? How do you not make, but make folks realize that maybe that $200, $300 a year start putting into that 401k in 20, 30 years is actually going to be worth something.
And there are some products out there, credit union or small dollar loan products, that tie a loan with savings. Up to 50% of the loan sometimes is a part of the savings, and at the end, there's money in the savings account. The interest paid on that money that was put into saving is rescinded, and they have a buffer so that they don't need loans. It provides some education towards asset building.
Thank you very much. Any questions from the fine group of senators here? Thank you very much. And again, I encourage all of you, if you have any comments or thoughts later on after the committee, please call us. We're here to work with you.
We'll do that. Thank you.
Thank you. I'll have the next group of panelists come up, which are nonprofits. What type of installment loans are nonprofits offering? I'll have Mr. Jose Quinones, Executive Director of Mission Asset Fund, Caitlin McShane, Communications Director, Opportunity Fund. Welcome. And it's interesting, Mission is really focused on personal loans, is that correct? And then Opportunity Fund is really looking at business loans?
Correct.
Good, welcome.
Thank you.
Ladies first, how's that?
Oh, we're switching it. That's fun. Well, thank you so much for having us here today.
Welcome.
I am really pleased to be here. This is our first time Opportunity Fund testifying, and we're excited to be talking about what we do. So first, I was going to give a brief overview, tell you about who our borrowers are, what our underwriting criteria is, and then talk about why we do this work and how we could do more of it with your help. So with that,
Well, that's exciting, that's what I wanted to hear.
woo!
How can we help?
All right, we'll get there. It's
We're
gonna
from
be
the
fun.
government and we're here to help.
All right. So Opportunity Fund is California's largest nonprofit microlender to small businesses by a long shot. When I say largest,
What's a microlender? much?
microlender is 50,000 and under, as defined by the SBA. The Opportunity Fund goes up to $100,000.
Terms?
Terms
length?
of 1 to 7 years. Interest rates?
50,000 up to 7 years,
Uh-huh. Well, 100,000 up to 7 years.
100,000 up to 7 years, okay.
Yeah. You want to hear more? So right now, we have outstanding portfolio of about $19 million in loans to
19 million in loans.
about 1,500 small businesses in the state. Right now, we're on a clip doing about 12 million in lending a year to over 1,200 small businesses. Throughout the state, we're mostly targeted in the urban hubs of the Bay Area and Los Angeles. In total, we've done $40 million in small business lending since our founding.
Nothing in Orange County?
Yes, in Orange County, Greater Los Angeles. Where we aren't yet is in the more rural areas, and actually up here in Sacramento is where we're just starting to be able to reach.
Thank you.
So the loan amounts range from as small as $2,500 up to $100,000. And our average loan size is about $10,000. So in there, in the businesses that we would serve with a loan that size, that's a big change. Who you're serving as a small business owner with a loan under $10,000 is quite different from who we're lending to with a loan of, say, $50,000.
How so?
Typically, what we're seeing are very much sole proprietorships and immigrant-owned businesses on our smallest small-dollar loans. And then from there, still most likely immigrant-owned because about 70 or 80% of our loans, 80% go to ethnic minorities. I think 60 to 70% go to immigrant-owned businesses. And at the top, we're seeing much
Give me a
large-
typical loan.
Typical
What's?
It's a
Lady making
landscaper.
tamales?
It's
or-
a lady making tamales. Se llama Alicia y se encuentra allá en Justin Herman Plaza in San Francisco. Y they are, self-employed people who often are without a brick and mortar or even retail establishment. Often doing service type work, so landscapers and daycare ladies and tamale ladies, all the way up to the larger loans. We're finding dry cleaners who are interested to switch out to the green cleaning process as opposed to the chemical based, and that equipment alone can run up to $80,000.
Yes.
Somewhere in the middle, we are the kings of the food trucks in California. So, this very popular movement happening with the food trucks. We have done over 100 already, and I think about 1 million this year in food truck loans. So for us, it's a perfect business. It's a business on wheels. And when we include the whole mobile
You
landscape.
got an asset, but it's unsecured loans, right?
Correct.
But you're gonna become secured, I guess, if you're gonna lend on the truck.
If we're going to lend on the truck, we take the truck as collateral, and we put a GPS tracking device on it. So far, so good. One was stolen and found in Texas. Otherwise,
With
they
no
stay.
food.
Yeah, no food. Very, very strict. Otherwise, it's a way for someone to get into business with fewer hurdles. And then from there, it's a job creator where it turns out you can actually fit 3 people in a food truck. And on average, Opportunity Fund's loans help to sustain or create 3
So
jobs.
how do you is it a job creator? Did they have 3 people there
Yeah,
before?
they have employees in there, yeah.
And did they then have 3 plus after the loan, or?
After that, where we see is a fleet of food trucks. So one of our biggest food truck borrowers to date is a gourmet ice cream truck company called Cool House. They're based in Los Angeles, and they have now 5 trucks, actually in multiple states, and we've just financed the ones here. And they also have now started 2 brick and mortar shops, one in Culver City, one in Pasadena, Old Town.
What are your typical interest rates?
Interest rates are between 8.5% and 18%.
What's your
And,
cost of capital?
Our cost of capital is lower from the banks through the CRA. I don't know, but I would say about 4%.
Okay.
Yeah.
So 4 and you charge 18. Do you make money?
Nope.
You don't make money.
Well, we generate income, but we don't cover costs, not through our lending.
How do you cover your costs?
Overall, for our operating budget, which is about $8 million, 60% is through earned income, 40% is through philanthropy in the community.
What's philanthropy?
Donations, and that comes from institutions, government, and individuals.
Is
Charity.
that like Reinvestment Act stuff, or?
There's some CRA investments in our loan pool, as well as donations by most of the major financial institutions in the state. And then beyond that, the foundations, corporate giving, and then individual giving.
So what would stop a depository financial institution from doing their own thing like you're doing
Like
right
we're
now?
doing?
Yeah.
It's not profitable.
Couldn't be a loss leader, so to speak. You
Uh-huh.
got all these food vendors that maybe in 5 years are going to be mega businesses. Wouldn't that be a great way to establish the
Yeah.
business relationship? And
Well, we do
therefore-
have strong relationships with our small business bankers in the community.
So you
And
can-
so the goal is to always pass them up. It's not necessarily with the first loan.
refer them to them, not pass them up, but refer them
Yes,
to
yes.
them.
Pass them along, refer them up. Outer Lands Cafe is one of the more famous restaurants in San Francisco. New York Times food writers love it. And we were able to help them when they were 2 people, husband and wife, just starting out with a $10,000 loan. Then we subsequently made them 2 more loans. The last one was $100,000. They expanded into the space next door. And most recently, they now have a loan from Citibank.
So
It
do
doesn't
you have an
happen
underwriting
always.
group that sits
Yes.
down and says, hey, this is not a good business, this is not a bad business?
Yeah.
Yes?
Yeah, so underwriting happens, we have underwriters, and then the underwriting actually begins with the loan officers who are out in the field working one-on-one with the borrowers. The
Are
underwriting.
these typical loan officers, are they like experienced loan officers that they go, or are they?
Are experienced loan officers, and most importantly, the majority of them speak Spanish, are Latino. Because we are trying to make sure that we're targeting our lending to the representation of the state of California in terms of who the small business owners are or could be, so that our lending reflects a breakdown of who
So lady
Californians
makes
are.
the tamales, do
Uh-huh.
you require also that she pass the health inspection by
Yes.
the county?
Yeah.
Make sure.
And that's part of how we verify time in business, is to see when they filed with the Franchise Tax Board and with the Health Department and all of that.
So they have to have, you're looking at really an established business operation that has some kind of a history of operating before you jump in and start making the $50,000
We don't incubate them
loan.
from the startup phase. So most often, like the tamale lady, she would have been referred to us by, perhaps a kitchen incubator group that we work with. And if she comes to us and she's still in the idea phase, we do really see the two-way dance where we'll pass her over to our, nonprofit colleagues, and then they'll pass her back when she is ready for the loan.
So there's probably a time from the time she starts selling tamales door to door to the time she has enough money to go and
Mm-hmm.
file all the state paperwork to get going. And that's when you pick them up, when they're really past the incubator.
Yes, yeah.
So are you limited? I mean, do you have the number of loans that you're making? You wish you could make more loans, or you have to turn people away, or you're trying to beg for more business out there?
We are, in terms of our capital constraints or our borrower constraints?
Yeah, what are your
Either
constraints
way.
right now? Growth constraints?
Our growth
Wait,
constraints are much more about raising the capital, which is a new problem. Opportunity Fund and the microlending sector in general with nonprofits in the country have never had this problem because we've never cracked scale, but Opportunity Fund has been growing at a clip of 500% growth over the last 5 years. So for the first time.
500% growth per annum.
Over the last 5 years.
Over the
Per
last
annum,
5
it's
years.
it's been about like 137% growth last year.
Okay.
So that's our biggest constraint, but we're not too worried about it. So far, the conversations are going well. I would mention we are an active user of the CalCap program, and it serves us very well.
So let me ask you, do you turn around and you gave somebody a business loan, clearly they're gonna possibly need payroll, the savings account.
Mm-hmm.
Do you offer that whole menu of other services, or that's where you team up with the typical bank to provide the other services?
To provide the rest, bank or credit union. And we offer savings accounts, but they're a very special kind called the individual development account that does the 2-to-1 matching using the AFI.
What's 2-to-1? Explain that to me.
So for every dollar that is deposited in the savings account, we put $2 on top of it. It's pretty awesome.
How long does it take for those $2 other to vest?
So the matching happens in real time, which is mostly made through monthly deposits. And then it takes typically our savers about 2 years to max out their account because we won't match into infinity, but up to a $6,000 total deposit.
So if somebody puts in 6,000, it's 18,000 at the end of 2 years.
If someone puts in 2,000, we put in 4,000, they close out with 6,000.
Thank you.
Yeah. I mean, I can go into more about the underwriting, or I can just talk about a specific borrower.
Tell me about your loss experience.
Yeah, so we get a
Defaults.
90% repayment rate, and then due to our friends at CalCap, we only have a 2% net write-off.
Say that again, 90% and 2%.
90% repayment rate, which means there's a 10% of the loans that are not working out. But of those, we only, as an organization, have to write off 2%.
What about the other 8?
The remainder are covered by CalCap.
Okay.
I think I would like to touch on briefly the impact here because Opportunity Fund is a nonprofit organization, and there's a real distinction when you have that. Sometimes it can be a matter of financial accounting, whether you're a for-profit or a nonprofit, a social enterprise, a B Corp. To us, it's important. We have a mission that's to advance the economic well-being of working people, to help them earn, save, and invest. Through that mission, then we came up with how do we do that? And it turns out that investing in education and entrepreneurship remain those two proven pathways to economic mobility. Entrepreneurship, the major hurdle is capital. It's one of the top 2 reasons why a small business will fail. So that's why we're a small business lender. Given that, we're okay that we're not covering our costs on our small business lending program because we have been able to run it successfully for 20 years now based on the support that we do take in on the side from the community. The whole point of it is to advance that economic well-being of our borrowers. So the tamale lady, what happens to her? We partner with the Aspen Institute on an annual basis for them to evaluate our lending portfolio and tell us what happened. And what we've found year after year is that incomes have gone up by about 37% on average for the business owners. And then they've been able to sustain or create 2.9 jobs, and 90% stay in business for at least 2 years after the loan life. So those are the things that we look at when we talk about why we do this and what small business lending means in the community. And the last thing I could touch on is what would help us be able to do more. So
Please.
with that, as much as I've said, you know, we're growing and we're doing great, one of our biggest constraints is that it's not legal for a nonprofit lender, that we have our lender's license, to pay a referral fee. And we do work with, for example, the food truck manufacturers. And right now, we feel like we could get more referrals if we were able to pay a referral fee, or same thing with, you know, potentially brokers and others. So that's something that we think from opening up the channel and making it wider. Right now, we find most of our borrowers through corridor walking and having our loan officers out in the community. And I think we could open up further channels, just like we do with the small business bankers. They know we're here and they know who to call. If we could incentivize referrals from some other key places, I think there's more small business owners out there that we would like to help.
You know, given the ever-changing economic environment in this country and in the state, there's more folks that are going to be looking to be self-employed. It's just the good old days of working for AT&T for 40 years and retiring I think are non-existent.
Yes.
So I think what you're doing is of tremendous value. So to distinguish, do you look at distinguishing from being self-employed versus being an entrepreneur? Or
Same thing.
To you, it's the same
Yeah,
thing? Okay.
same thing. Yeah.
Okay. And so do you keep data, like you said, when that truck food vendor creates jobs? Do you have any data there of what the multiplier effect has been in terms of creating jobs?
Yeah, each loan on average creates 3 jobs,
Okay.
and the average loan size is $10,000.
So a venture capitalist sustains major losses because what they're looking for is that one investment that pays off 100 to 1, and that covers their other losses. Do you guys look at that analogy at all and how that would apply to you?
I don't think so. I think seeing our 90% repayment rate and 90% business survival rate, we're going at this from a perspective where we're intending every single one of our borrowers to succeed.
You're a nonprofit right now, and you have that 90%. What would a bank typically have? What would their loss experience be to sustain profitability?
I don't know that.
10%, I think that's probably a little bit high.
Yeah.
It's probably 10% would be unsustainable, I would
Yeah.
imagine.
Yeah.
So I'm just trying to figure out how we could take your model and, kind of increase the probability of success.
Yeah.
Whether it be through underwriting or maybe additional programs for the small businesses to figure out how to survive.
Well, I think that's been part of the challenge in the nonprofit microlending sector in general is how much risk to take. And part of the trouble with scaling the industry, or the lack thereof for the last 20 years, has been not taking enough risk. So, what we're weighing is how many people can we reach and make a big impact with, and knowing that, sometimes along the way, it won't quite all be, it won't work out great. To us, we're psyched, and that's an industry-leading repayment rate, despite the fact that we have some of the more aggressive lending in the country for nonprofit microlending.
But it works for the
It
most.
works.
90% of the time it works.
Yeah, and I think there's one other fun number that really speaks to the idea of helping people get a foothold in the financial system, which is when we splice out our portfolio, who are we lending to? 15% of the businesses come to us without a FICO score, and 30% have a FICO score of 550 or below. And that's also some of the more aggressive lending by a nonprofit microlender in the country. So how much loss risk can we tolerate compared with, can we reach some of the more needy people? Because a bank would look at all of our borrowers perhaps and say, oh, no thank you. But we look at all of them and we say, yes, please. And Opportunity Fund in particular is one of the, works hardest to reach the deepest.
Well, let me re-ask a question, which
Sure.
is, would you have data to answer the question that I believe is important to us as policymakers, which is, 90%, but how many of those folks would you say you have pulled out of poverty and have essentially made them middle class?
Closest we get is looking at their...
You got somebody with a FICO score in the 500s.
Yeah.
You got a problem.
Yeah. We know how the credit scores improve over time with our repeat borrowers. We don't yet have a way to pull a credit score on a borrower if they don't have a reason for us to make that hit on their credit report again. Our evaluation manager would love to get her hands on that. We have had some initial conversations with some of the credit reporting bureaus about whether there would be a way for us to do that without affecting the borrowers, because from our repeat borrowers, we do see the credit scores going up.
And the question is really one, and I'm stretching here, but would this
Sure.
be a subset, a sub-question of a bigger question we're asking ourselves in society, which is, you have a shrinking middle class in this society, and
Yeah.
is this a way to
Yeah.
re-engineer the possible emergence of some folks in middle class, which is,
Yeah, I think we
being
have the data to know
self-employed.
the credit scores going up of our repeat borrowers. We have the data from the Aspen Institute to know the 37% increase in business income for the owners. So those things would drive at it, but ultimately we would want to see annual household income proving establishment in the middle class. And that we don't have, but we would love to get.
questions from other senators?
Simply a very refreshing presentation. Thank you very much.
And again, well, let's move to Mr. Quinones, Mission. Welcome, sir, and good to see you again.
Well, thank you so much. It's a pleasure to be here. This is my first time also in this body, and it's a great honor to sort of kind of come and tell you the story of the Mission Asset Fund. And also, it's an honor to be sitting next to Opportunity Fund, they actually are a giant in our field, and that I've actually taken a lot of our lessons from what they've done, in the Bay Area. So, the Mission Asset Fund, we are a small nonprofit organization based in San Francisco's Mission District. We got started about 6 years ago to help low-income immigrant, the community in the Mission District, to help them reach a higher state of financial security. We did that through our mission being that we wanted to work with financially excluded communities and help them become, active, visible, and successful actors in the financial mainstream. And we're doing that through creating innovative programs and services to sort of help them actually become that successful in the financial mainstream. We pioneered, a program that we call Lending Circles, that basically takes the concept of a tanda, right? Tanda, Condina, Susus in the Caribbean. I mean, lending circles are ubiquitous throughout the whole world, right? And the way I sort of frame it is
That concept is popular probably throughout the world, I
Yeah,
believe. In the
it is.
Asian community, it's also,
That's exactly right. I mean, I actually read, a book that talked about the history of tandas in Mexico as being that it was an idea introduced by the Chinese railroad workers of the 1800s.
oh, really?
Yeah, I don't know if that's true or not, but I love that story anyway, so I tell
good
it all
story.
the time. So I'll keep repeating it until it becomes true. But I love the idea that, there was this idea, this concept that is so good that is still prevalent all throughout the world. And it was actually the genesis of the credit union movement of the, in the late 1800s. It was a group of German farmers in Germany that got a lending circle together, and it just sort of sprung what we know and love as the credit unions
Sticking
today.
together, helping
Yeah,
each other
exactly.
out.
So, but what we did is sort of recognize that the activity in those circles was sort of bona fide financial activity that people were lending and borrowing with themselves. So you mentioned, the group of 10 people, pulling $100, and then now you have $1,000, and then somebody takes that $1,000 on a monthly basis, and they do that in rotation until everybody has a chance at getting that $1,000. So they do that through what we call, it's social capital, their relationships, their connections with each other. It is through people that know each other, either through family, co-workers, friends. They sort of make those agreements. But what happens is that it happens very informally. So we have essentially two financial systems. One is very formal in the way we interact with it, and then there's a very informal financial system that is essentially done through these lending circles. And so our innovation was this, 5 years ago, we said, well, how do we start and work with them where they're at? Meet them where they're at, build on what they're having. And so we said, well, let's recognize that activity as bona fide financial activity that should be recorded and reported to the credit bureaus, because the lending and payment activity that is being done in lending circles is exactly the same as the lending, and the payment activity that we do within the financial sector, where we make payments and then that gets reported to the credit bureaus. So the way we did that is we devised a promissory note, to make it formal, and we devised a program agreement where every participant signs, and then they sort of then hold MAP as a servicer of that loan, what we call a social loan now. So as a servicer of that social loan, we're then we have the responsibility of then recording and reporting it to the credit bureaus. So what we do is essentially is service it. We guarantee the loan to make sure that everybody that the participants in our program are made whole in case anybody walks away without paying up. And then we also use the opportunity to to inject financial education, where we talk to them about, credit, savings, financial systems, and, who is FICO, who is that guy, right? I mean, we sort of break it down to the point where we say, this is how the system works here, and so that they can start, correcting their behavior and making sure that they're playing by the rules that they have to know. And so we do all of that.
Charge an interest rate?
So we do not, because we have a zero interest, zero fee loan, and it's actually zero risk for them too. The reason why we decided to not charge an interest is because at the end of the day, this is their money that they're lending to each other, right? So this is their capital. It's not our capital. It's not a capital that we had to go out and get from Citi or some other venture capitalist. So we have no cost of capital.
But there's an overhead cost.
There's an overhead cost indeed, and we've been very successful at fundraising, getting philanthropy to actually cover that for us, because what we've been able to say is that the value that we've created through this program is creating, a much more a prepared borrower, if you will. So we've actually expanded the pool of eligible borrowers for lenders to enact, because when we saw the market of, in the financial marketplace, there's plenty of lenders out there, that want to do business with, prepared borrowers. The issue is that there's a lot of borrowers that can't interject in that marketplace because they have no credit score or they have a very bad credit score. And that's especially true for low-income immigrant population. So our idea to sort of say, well, let's use your money to work better for you by us reporting it to credit bureaus, right? And us.
What's the reception of the credit bureaus to your data?
They love it. Why? Because they benefit from having, a new
Additional
data
data.
source.
Yeah, they
Yeah.
have additional data.
No, they do. They love it because, our information is thickening their files so that they actually are producing, FICO's producing those scores, or Advantage scores producing those scores. So it's to the point that even Experian, as an institution, they invited me to join their Consumer Advisory Council to essentially meet with them and talk to them about, more innovation in this space. So they love it, the consumers love it, one, because, with the credit score, with the credit history, they are able to, interact in the financial marketplace in many ways that was prohibitive to them. So it's not just about, business members or small business owners, but it's about, that worker that is working one or two jobs, but because they don't have a credit history, they can't even get an apartment. Because nowadays, even to do that, they need that credit history. So through our program, we're sort of touching not just the small business folks before they start making the tamales. So it's even before they get that apartment to start making the tamales, to start selling it. So sort of like the pre-rungs before we can actually then hand them over, to microlenders like Opportunity Fund and others. So the concept here is that, that we're sort of recognizing what people are already doing with their money and validating as, bona fide financial activity. And through our servicing program, we've been able to sort of show dramatic improvements in people's lives. And I would love to sort of show you a chart that
Please.
sort of documents that. For the past 2 years, we partnered with San Francisco State University that did an evaluation of the program for us. And what they found was, I hope you can see this. I think there's some copies. Do you have the copies? Well, then I'll show it to the video guy. Can you see that? Essentially what they found in the evaluation was that over a course of 10 to 12 months, people are able to increase their credit scores by an average of 168 points. Now that number is that large because about a third, 35% of our clients start with no credit, essentially zero. So they go from 0 to 600 or 620. Folks that start with the credit history, they actually also increase their credit scores by an average of 19 to 20 points. So what we see here is that, and because it's also a zero interest loan, we saw that people are able to increase their savings, right? Because of not taking out a loan of zero interest or fees, that we estimated that total of the amount of money that we've been able to help them save is about $617,000, and because they are able to then access other low-cost credit. The evaluations show that on average, people get 3 additional trade lines, like another credit card, another, low-cost installment loan, and they're essentially are able to refinance their high-cost debts. So they're paying down that debt by an average of about $1,000 over a course of those 10 months. And so we projected that finding out to all of our clients, and we estimate that we've helped lower the debt by about $1.8 million. And so this is numbers that are not self-reported. These are numbers that we have been able to track through their credit history. So there's like hard numbers, from our perspective.
So in addition to doing the loan, do you sit down with individuals and say, hey, this works out better for you, why don't you try the following debt restructuring?
That's exactly right. That's the whole premise of our financial management training, is to sort of talk about how to manage debt, how to manage credit, what are the different products out there, so that way, that idea, that information is actionable as they're sort of going through the program, at our organization. And so we've, again, demonstrated a huge success of moving the dial, of getting people that have been invisible before in the marketplace to become visible. Philanthropy and also financial institutions have seen the value in us expanding the pool of eligible borrowers for them to engage with, in the long term. And then for us to sort of say, look, through this activity, we are helping, again, kind of create this, the social, kind of a social value of sorts. And so because of that, a lot of other nonprofit organizations have wanting to replicate our work. And so a lot of other entities, as we heard earlier today, are taking that idea and trying to say, well, what can they create around this idea of this informal activity? So then we then partnered with a number of different organizations. Right now we have about 19 partnerships across 6 different states, 13 of which are here in California. And we're essentially are working with them to provide the product and the program in their own respective communities, so that the spike that you see for year 3 is when we started, partnering with other organizations. So this work, we don't just do it in San Francisco anymore, but now we're doing it, in Los Angeles, working with a group called the Filipino Worker Center and New Economics for Women and others. And even next week, I'm going there to try to identify other prospective partners. So the idea of having an innovative program that actually works is there, and philanthropy has been, willing to invest in that and make us expand that.
Thank you.
I do want to address the question of what we need in terms of help, and there is a question about, because MAF is not a lender. Technically, the people that participate in the lending circles are the lenders and borrowers themselves, and we as a servicer, have been able to feel that we have been exempt from the lender's license requirements, even though we adhere to all of the protocols of managing people's money to the T, and even more so because we're very careful of orchestrating all that. And I think one of the asks that we have of the body is to help us sort of recognize the activity and formalize it even further by being regulated. So I don't know if this is probably
Come
the
at
first
me
time.
against.
Yeah, exactly. Probably the first time you hear this thing, like, please regulate us. But I actually do feel that through the state recognitions of this activity, it would actually help us, kind of get assurance of the marketplace and get other prospective nonprofit partners to join in this effort.
Thank you.
Yeah.
Question mark or comment? I'm not sure. Thank you. Okay, good. Any activity in Orange County?
Not yet. I do want to go there. I hear there's a lot of great taco trucks there. But
Quite a
that's,
number of them.
Yeah. That's the idea, is that we definitely want to, seek out those partnerships in a lot more aggressive manner. But having, that sort of regulatory assurance, I think, will give us the confidence for ourselves in expanding the program, but also give the confidence to our philanthropic investors that this is really the way to go, and having the state sort of sanction the activity. So I think there's definitely, we're scratching the surface, and I think I'm being generous at that. But I think the potential of this as being a ladder, or, an on-ramp to
I think you're being humble, not generous. I think you are scratching the surface.
Yeah, I completely agree, and I think this is sort of still like a pilot of it, but I think we demonstrated success enough to sort of say, what, there's something there. for us to sort of, to build upon that. So any ideas or help from in your office, we will greatly appreciate.
More than happy to talk to you and anybody else. Ms. McShane, I did have a follow-up question for you. You talk about the need for a referral fee and being able to legalize a referral fee. I guess my follow-up question would be, would that make you more profitable or less
Less profitable? It would probably, in the way that we've calculated it.
loss?
Right, we'd
Cut
probably
your
break
losses.
even because we'd have to pay the referral fee, but we would get more business from it. And that would drive up the volume, which increases our efficiency with
Because
every additional.
putting on my old MBA hat,
Yeah.
I mean, your margins are probably not going to move a lot, but if you take whatever spread you have right now, multiply it by a higher number of loans, you may end up being profitable someday. And that's what I'm trying to figure, is a strong argument there
Yeah.
that paying that small referral fee
Would
ends up more.
crack us that much further.
Yeah, you got it.
Yeah. I don't know that anybody is hoping that it would take us that far, but it would certainly move the needle. We have a 5-year goal right now. Our self-sufficiency rate, where we are towards break even, is at 67%, and we want to move it down to at least 59% in the next 5 years.
Thank you.
Yeah, thank you.
Thank you very much for panelists. Job well done. Thank you. Our next panelist is Ms. Lisa McGreevy, President CEO of Online Lending Alliance, and we'll be discussing the topic of what type of loans are being offered by lenders unlicensed in the good state of California. Welcome, Ms. McGreevy.
Great, thank you, Mr. Chairman. I really appreciate being here. I'm accompanied today by John Caldwell, who is our counsel here in Sacramento. and
Welcome,
with
sir.
Mr. Greg Porter, who is
Mr. Porter,
our
welcome.
State Government Relations Counsel. I really appreciate the opportunity to be here to talk with you today about the increasing use of technology and mobility in financial services. As your committee knows, there is a rapid growth in financial transactions moving not just online, but to our smartphones. The same trend is true for short-term consumer lending. This year, industry analysts project that of the $48.7 billion of loan volume, more than half will be online. That's the first time that's ever happened. Many of the new products and innovations in small dollar lending are taking place right here in California. California is really the laboratory where technology, innovation, and financial services come together.
So this is where it's happening.
Absolutely.
Reminds me of the story of internet poker, where most of the transactions are in California.
There are a lot of creative people in this state who know how to use the internet. We hear those stories every day, whether it be in online lending or in other kinds of businesses. So I really think that you have an incredible opportunity to create a new consumer lending regime that can be a model for the entire nation. We're all confronting the challenges of regulation in this rapidly changing, dynamic new world of financial innovation. We understand the challenge that you and your colleagues face as legislators, as well as regulators, when you try to correct the balance between consumer protection, innovation, and rapidly changing technology.
Are you trying to say here that we have an opportunity maybe to, create a regulatory regime that would accommodate you being licensed in the state of California?
Absolutely. I think this is an incredible moment in time.
So this is your olive branch.
I think it's more than an olive branch. I think that you have the opportunity and we have the opportunity to bring the ideas of what's happening on the internet, what's happening in small dollar lending, the innovations that are going on, what the smart people in Silicon Valley, San Francisco, and around the state are doing to try to change this marketplace. And I think you have the opportunity with your committee to think very boldly about where can we go, because evolution and change and innovation in this industry is happening overnight. And that's one of the things I want to talk to you today about.
Please.
So as I said, we're here because I think this is an opportunity for an incredible dialogue. Our industry is pioneering advances in technology, software, underwriting, so that lenders can provide smarter, more cost-effective credit options and at the same time help consumers access more traditional credit markets, one of the things that we've been talking about. Throughout my testimony, I hope to answer a number of the questions that you have asked us, the committee staff has asked, so that you have a better understanding of the online lending industry. Who our customers are, and you might be surprised at the answers to that, and then how we might work together to serve some of these customers. So who are members of the Online Lenders Alliance? We're the trade association of more than 150 members representing lenders who make the loans, advertising and marketing agencies, specialty credit bureaus that play a pivotal role.
Specialty credit bureaus like,
So you've been talking about FICO scores. Many of the people who are coming into the financial world are people who are known as thin files, who don't have established credit or large files at credit bureaus.
Okay.
So their credit scores may not be the best indicator of their ability to access credit, to be able to take on that credit responsibility. But they may be people who have had a history of paying rent, paying other bills, and so these specialty bureaus have grown up to try to gain that information and try to help give us lenders a broader picture, not just a narrow picture of a FICO score, into who that borrower
so it's a
is.
specialty credit bureau that looks at other factors beyond the traditional factors that a big credit reporting agency would typically look at.
Exactly. Most credit reporting, the big three credit reporting agencies only accept information on monthly payments. So if you have a mortgage, if you have a car loan, if you've done business with a large financial institution and you're paying your credit on a monthly basis, then you can report. But the bureaus don't, the big three bureaus don't generally take into account rental payments or other payments that happen on a more regular basis. So that information isn't part of the big three bureaus. That's where these specialty bureaus come in, to try to give a fuller picture for people who are thin file users of credit. So they're a big part of our industry.
How many of those exist?
I believe there are 5.
5?
Or 5 that are part of our association.
Okay.
And we also have a number of other technology companies, including software, data analytics, and other necessary elements to help support the online lending platform.
Do you have programmers that kind of look at the logarithmic
Come to one of our
files to
conferences and you'll
determine
see all kinds of different.
probability of who pays and who doesn't?
The data analytics and using information that we receive in all kinds of different ways, some from the specialty credit bureaus, are a major part of helping us identify who the customer is, because when the customer goes online, we don't get to see them in person. They don't walk into a retail operation, so we don't get a chance to verify their driver's license and that their driver's license matches their physical presence. So we use all kinds of analytics. One of the things that we look at is when you come online, what is your ISP address? So there's all kinds of analytics that have grown up that we take advantage of to try to make the identification of who you are and who we're lending to. That's a big part of what we do. So it's very important that we know who we're lending to, know about our customers, the same things that anybody else would do. But when you do it in an internet environment, you have other things that you need to do to try to make those identifications. So software, all the technology companies are an important part of what we do. So as a trade association, we have made it our mission to develop and maintain a very rigorous and robust set of best practices. Now, a lot of organizations have best practices, but as you can see from our book here, we have pages of mandatory compliance that are requirements for membership in the Online Lenders Alliance. So in order to become a member, you have to comply with our best practices. So I brought copies for everybody here, and it's also posted on our website. at www.onlinelendersalliance.org. These best practices cover every aspect of the industry, from lending practices to online marketing and advertising, payments, and collections. You'll find that these best practices align with more than 18 federal laws that our companies must comply with. Laws like the Truth in Lending Act, the Fair Credit Reporting Act, Dodd-Frank, Electronic Fund Transfer Act, and there's a whole bunch more. With these laws and regulations, we're also subject to rules that come out of the Federal Trade Commission, Consumer Financial Protection Bureau, FinCEN, and other regulators like NACHA, the Electronic Payments Association. We take compliance with these best practices very seriously, and we act in some ways as sort of the cop on the beat. One of the things that we've done is create an accreditation program, which is conducted by an independent third-party organization, and it follows the Consumer Financial Protection Bureau's supervision and examination manual and our best practices. The point of this program is to ensure that our companies create and maintain a culture of compliance, to ensure that members are executing loans to customers based on very strict guidelines. As association members, we've also worked hand in glove with the FTC to help them prosecute fraudulent debt scammers. We continue to work with the CFPB in their efforts to protect consumers while at the same time ensuring access to credit. And frankly, isn't that why we're all here? Is to make sure that consumers who use any financial products, regardless of what they are making informed decisions and have the best possible options available to them that the market can bring. You know, there's no denying the fact that Americans are facing a credit crunch. That's what we've been hearing about this morning, what we've been talking about. According to the FDIC, there are approximately 21 million Americans who are underbanked. I find that to be a staggering figure. So when we look at our internet customers, here's what we know about them. We know that they do research and they know their options. Nearly 2/3 of our customers have either attended or graduated from college. They're pretty well educated. They are working middle-income families who are savvy consumers who probably have more than likely run into an unexpected emergency or, frankly, too many bills. So here's just a quick little story from a woman by the name of Stacy from Vista, California. And here's what she said. I have been saved more than once by a loan or advance. Without them, I would have ended up with utilities shut off, other bills not being paid, or without gas to get to work. Having these credit options available is a huge relief to me, she said, and I'm grateful for their use when I am in need of them. There are hundreds, if not thousands, of situations like this, where our lenders are providing a needed service that no one else offers. I applaud those who testified today and am really invigorated by what they had to say about the programs that they've put together. We applaud them, but we need to make sure that we can scale some of these programs. And while it was great.
What do you mean by scaling?
Well, so we heard this morning about these great philanthropic organizations who are bringing lots of innovation into the industry, who are supported by private philanthropic organizations, who are making great loans here in the state of California. But the reality is that these organizations are only scratching the surface of this need. So in just the fourth quarter of last year, one of the specialty credit bureaus that we talked about, and one who's working with the CFPB, the Consumer Financial Protection Bureau, to better understand this industry, tells us that there were more than 1.8 million online short-term loan applications from Californians. And search data suggests that more than 7.5 million Californians have searched online for short-term loans.
Will these be payday loans or installment loans or both, or
It's a combination of loans.
do you do both online?
We do both. And what's happening is customers are changing And we're finding that one size doesn't fit all. So what some people thought was good for them in a payday loan, where it's a discipline of a 2-week payback, other customers need larger loans for longer periods of time. So, you know.
So let me ask you on that
Sure.
specific point. The terms that you offer online versus those of California licensed versus non-California licensed, I should say, how do they differ? I mean, what's the difference?
I think some of them are very similar. I don't have the statistics to be able to
Loan
give you
amount,
the
interest
answer.
rate, terms, give me in generally what the main parameters are, big points of the difference.
So I think, the difference really between the loans is how they're obtained.
Okay,
So most consumers who go into a storefront, find the storefront because it's located in their neighborhoods.
Right.
If you want to find a loan online, you have to go and search for it. Generally, what happens is people put a term into a search engine, and they look for a loan. And there's all kinds of options that come up, just like you would search for any other product on the internet. There's very clear disclosures in advertising and marketing. I think that's very similar to the storefronts. I think the big difference is one, you walk into a retail operation, and the other is you go into the privacy and security of your own home and go on a search engine.
so you're being general in your answer, so let me, am I to presume that the terms of the loans are very similar to those that you would get at the brick and mortar versus online?
I believe that's the case, yes.
Okay, so you also mentioned that 2/3 of your, clientele, so to speak, or applicants, I don't remember which term you used, are college educated.
Right.
So we're looking at a generational phenomena, whereas I'm more comfortable walking down to the brick and mortar versus a 21-year-old that's more interested in being a couch potato and going online and picking up, and not, let me restate that, somebody who's sophisticated enough on a computer who can essentially shop at 100 different places online, as opposed to Lou, who would rather walk to 2 or 3 places. Are we looking at that difference?
I think you're on the track here. What we see about people who go online is that they like going online at a time that's convenient for them,
1 or 2 in the morning?
whenever. I think about, the example that I use is that sometimes I'm paying my bills online at like 9:30, 10 o'clock at night. And I'm, going through on the online banking and saying, yeah, I'm gonna
Sure.
pay this, I'm gonna pay that. And all of a sudden I realize, oops, I'm a little short. I'm not gonna have enough money in my account to be able to pay all those bills that are either due or that I wanna pay. So I can go online and I can take out a short-term loan and be able to, without anybody knowing it, without my neighbors knowing where I am, that I'm having a problem, be able to fix my need by going online. So I think the demographics are changing, and I think it is a bit of a generational change. But I also think that,
Let me presume that the demographics are changing, the customs and practice of folks doing business are changing, that would probably move in the direction of online business, therefore online lending as opposed to not.
online lending has become a much more household.
It's becoming even bigger, I would imagine.
Absolutely, absolutely. We see it in the mainstream financial institutions where online banking, branches aren't as important as they used to be because you and I are busy people and we don't always have time to go into a branch, and the same is for the entire population. So, and that's really why we're here, right? Because the world's changing and the needs of our customers are changing. So where before a 2-week loan might have made a lot of sense, what we're seeing now is people want larger amounts for longer periods of time.
And you can make larger loans.
We can, and we want to, because we want to meet at the end of the day, we want to meet the needs of our
Because
customers.
you're not regulated by the state of California.
Some of our companies are regulated by the state of California, some of our companies are not, and many of our companies would like to be able to do business in the state. And that's why I'm here. So we want to, talk a little bit about how we deal with those 7.5 million Californians who are looking for small dollar credit. And how do we do it in a way that's beneficial to them? So first, the current California deferred deposit transaction law, we believe, is outdated. And it doesn't really serve consumers very well. Our customer data shows that the average loan size is about $450. So in California, that would mean a consumer under the deferred deposit law would have to take out 2 separate payday loans from 2 different lenders, and they'd have to manage those loans come payday. Under the California Finance Lenders Law, the same customer, if he wanted $450, would actually have to qualify for a $2,500 loan when they only needed $450 to begin with. Mr. Chairman, that just doesn't add up for the customer, and it just doesn't make any sense to me. But we really applaud the efforts of the legislature to renew the pilot program for increased access to responsible small dollar loans. I think it shows an understanding that the current law is really insufficient. However, we're concerned that the program may repeat the results of its previous version because the legislation severely limits product offerings and I think, frankly, stifles innovation. So I'm here today in hope that California will be the leader that will craft legislation allowing consumer needs to be met through product innovation. For instance, if a customer needs $400, why make them take out 2 payday loans? Instead, why not give them an option of an installment product or a flexible line of credit that allows borrowers to choose their payment periods and the amount they need? Installment loans are available in other states right now. One of our members offers a product called Net Credit. Not only does the customer get to choose flexible options based on their creditworthiness, this product also gets reported to 2 of the 3 traditional credit bureaus. So we've been talking about this helps consumers who make full on-time payments build their positive credit history. Another one of our companies has introduced a product called Rise. Rise is also an installment product that has rates that start at less than 1/3 of what traditional payday rate might be. Rise also reports to TransUnion and provides customers with free credit monitoring and Financial U, which is a free online learning center that helps customers understand essential financial concepts and practices. Similar to Net Credit, Rise also helps customers flexibility in designing products that fit their current needs. There are a couple of other also very exciting new products, one in particular that I want to talk about, and that is a product for employers to help their employees. It's a product called Elastic, which a member company introduced at Finovate Fall 2013. This product allows a line of credit to be offered and integrated with company payroll systems, so employees can access credit at a cheaper cost. These are some of the innovations in financial services that we think could really work to help develop new programs for customers and consumers in the state of California. I thank you for the opportunity to be here and to talk to you. I truly view this as a chance to work together to address the growing demand for short-term credit products in California and to make the state a leader in internet lending innovation. And I look forward to your continued
Ms.
questions.
McGreevy, let me ask you if I can, just a couple of other questions. You talked about the changes in the law in the state of California that you would like to see. Are you at all approaching legislators at the federal level about changing laws at that level?
Yes, we are. We're talking to you, we're talking to all the different states that we
How about at the federal
operate in,
level?
and at the federal level as well. The internet is an interesting opportunity. It's a
Sure.
delivery method, and it's one that, as I like to say to people, the internet knows no bounds. It doesn't know state lines, it doesn't know national lines, and so creating a operating system for companies that operate on the internet is really important. We now have a federal regulator in the Consumer Financial Protection Bureau, but unlike other federally regulated entities, we don't have a federal licensing regime.
So you're looking at a federal licensing regime?
Absolutely.
Let me ask you, coming back to the state of California, have any of your members gotten any letters of cease and desist from the California Department of Oversight?
I know that the department has issued letters. I'm not sure, we don't keep track of those kinds of things in our association, so I don't know. I assume some of our members have gotten them, but I don't know.
Have any of your members, as a result of that kind of activity, stopped doing business in California?
I don't know the answer to that.
Well, thank you very much. Appreciate your testimony, and I look forward to working with you and exploring some of the concepts that you presented today in this committee.
Thank you, Mr. Chairman. I
Thank you.
appreciate your time and your interest.
Thank you for flying out here to be with us. Appreciate it.
Absolutely. My pleasure.
Our fifth panel, the regulatory response to lenders that lack California lending licenses. We have the Department of Business Oversight with us. Welcome, Mr. John Hanna and company. How are you doing today, sir?
Thank you, Mr. Chairman.
How's Orange County?
Orange County's beautiful. I was there yesterday, and it wants to welcome you back anytime.
As well as I was there as well.
Mr. Chairman, Ms. Newhall, and Senator Iso, and if I come back, John Hanna, General Counsel for the Department of Business Oversight. I'm pleased to be joined on my right, Scott Cameron, who's the Deputy Commissioner for Banking, Marianne Smith on my far left, who's the Deputy Commissioner for Enforcement for the Department of Business Oversight. And my near left is somebody that I know you're well acquainted with because she's testified here on behalf of our department, our Wunderkind in Law and Policy, Colleen Monahan. Let me just say that, and I know you've heard this part before, Senator, but I think it's important for the record to reflect on it, on the reorganization, that the Department of Business Oversight merged, it was part of became the merger of the Department of Corporations and the Department of Financial Institutions of July of this year. And so it brings into one department the regulatory oversight of state-chartered insured depository institutions and lending enterprises, including banks, credit unions, finance lenders, residential mortgage lenders, and deferred deposit transaction originators, commonly referred to as payday lenders. Now, the reason why that's extremely important for this hearing, I think, is because that consolidation creates opportunities for the department to leverage its resources in the regulation of financial products and services in the state. And I'll get into that in a second as how we've done that.
Thank you.
I've been asked to provide an overview of the department's enforcement of the California's deferred deposit transaction law, especially as it regards unlicensed lending, as well as the department's efforts to provide guidance to depository institutions under its authority. Before I go any further, I should have mentioned this beforehand. Commissioner Owen wishes she could be here and testify herself. She is on state business out of state. And wanted to also express her regrets to Assemblyman Gatto on the very tragic death and killing of.
And we join with you in extending some member of Gatto our condolences in that tragedy that his family experienced last night.
Yeah, just terrible.
We all share in his grief.
Amen. All right. So since the deferred deposit transaction law became operative in 2004, our department has been responsible, our predecessor Department of Corporations has been responsible for regulating deferred deposit originators. And prior to that date, it was done, they were regulated on a permit basis by the Department of Justice. So in 2012, which is the last data we have, and that's more recent data than the last time we appeared before you, the department licensed and regulated deferred deposit originators at 2,100 locations They made more than 12.2 million payday loan transactions to more than 1.7 million individual customers, totaling more than $3.2 billion. And the average transaction was about 17 days. And the, I think, I don't need to go over actually what the process is, but I want to say that we've heard something about innovation today, earlier in the testimony, and it is true that that there is some change, more online activity, but we're finding that online activity is not synonymous with illegal, unlicensed payday lending necessarily. About 8% of the payday loans that are made by licensed payday lenders in the state is done online, and about 8% of the payday lenders who are licensed do online activity. So there's nothing inherently impossible, difficult, or creates a barrier from a
Not an exclusive business to one or the other.
No, you can be licensed in the state of California and do online activity. There's nothing that would prevent that. Now, it may be a more attractive business model in some people's minds to not be licensed, because then they evade the scope of enforcement, the jurisdiction, the consumer protection laws of California. But I think the statement we want to make very clearly here is that businessmen and women in this state who are offering a product that the state legislature has decided is going to be made available to the people of California, they're able to do that in both brick and mortar and online activity, and they are complying with the law, and they are doing it on a daily basis. So it just, I think that was important. That's not in the written testimony that I've got, but I just wanted to reflect on that since a lot of the information that I heard. Banks, credit unions, and other depository institutions are exempt from licensing under the Deferred Deposit Transaction Law. So what's the role of the department in regulating this law? We're to ensure that the policies underlying the law are met by the companies licensed by the department. So these policies include providing strong regulatory oversight of deferred deposit transaction industry and guaranteeing that consumers have the information necessary to make informed decisions regarding deferred deposit transactions. Strong regulation and information for the consumers, ensuring that happens. Now, there have been substantial technological developments in financial services since this law took effect, and these advancements have changed the nature. Instead of a check, which the payday lender holds, it now is done oftentimes with an ACH. So
What's ACH?
it's the automatic clearinghouse,
Thank
which
you.
will hold the money, and so you don't have the physical check in that kind of situation. So our challenge is to make sure that existing statutory requirements under this law are applicable in today's paperless, virtual, and internet-based world, and ensuring appropriate oversight of a 21st century deferred deposit product and it's a regulatory challenge, but we're up to that challenge. Now, what about our efforts to deal with illegal, unlicensed lending, online lending? Step back and just what we do with the licensed regulators is they receive regular examinations, not less than every 2 years. And those examinations, by the way, are not like the CFPB, where they give you notice and that you know when they're coming. You don't know when we're coming, and we find that is actually helpful.
What do you look for?
Pardon?
What do you look for?
Well, we look to make sure, for example, that there's consumer protection information at the brick and mortar sites. We're making sure that there are not unlicensed lead generators being used. We've heard earlier about referral fees, and I'll respond to that in your questions if you have some later. But the department's viewpoint is the legislature has been very clear that anyone involved in this activity needs to be licensed. And there's real strong consumer protection reasons for that. It's to make sure that you minimize fraud, you maximize information. Consumers have a lot of choices in this state. We're not here, this department, to minimize those choices, but we want to make sure that those choices come with complete information so that and consumers can not just make a choice, but they can make an informed choice. So, again, not less than every 2 years, but also anytime the department wishes, we can obtain information from the licensee. Let me give you an example. We get a complaint, a company that is strong-arming and enforcement and trying to get the money back, didn't give the consumer all the protections, the information they were aware of. We can go out and we can conduct another examination, or we can make inquiries. We can
Is that the nature of most of your complaints?
Well, they vary. Some of the complaints are, most of them deal with, we didn't have a lot of information, we didn't know where to go, we didn't know what the percentage rate was. And I defer to Colleen, is there anything else that was substantial in nature in terms of complaints?
In terms of complaints, the law requires that our number be on the contracts, so a lot of times we get inquiries when consumers are thinking they're calling the company. So a lot of times they're directory. We don't receive a lot of complaints from licensed payday lenders. We never have since the law was enacted. We don't get what you would expect to see, complaints about the fees, because it's such a clear fee. Folks know what they're getting into. The complaints might be business practices related, rudeness, or something of that nature.
So, but what we also do with a lot of these complaint senators, we're able to assist in the resolution of some of these complaints. Sometimes you have a payday lender who had somebody at their office who maybe didn't provide exactly the information. We get that taken care of. Sometimes it's just a matter of explaining what the law is to the customer. But generally, we find that most of the complaints we have are resolved satisfactorily by the complainant and the actual industry, the payday lender. But we're often able to facilitate those complaints. Now, since January of 2013, the department has issued 16 enforcement actions against unlicensed online lenders, including illegal lenders operating from Costa Rica, Malta, Belize, and the United Kingdom. This is they're very difficult to catch. But when we have the evidence, when we have the facts, when we have the law, we go after them.
Let me ask you, is there a distinction between payday versus installment actions that you've taken, enforcement actions? And the other one is, you're talking about payday that are offshore, literally outside the continental U.S. What about those within the continental U.S.? Any distinction there?
We take action against online activity within the United States as well.
And
but
help me out here to understand, is there a distinction here in terms of compliance between those that operate in the U.S. under U.S. law versus those that would be in Belize that would probably not operate under any sort of law that the U.S. would have jurisdiction over? Am I thinking correctly, or
the reality is, and we heard earlier that California was a laboratory for ideas, activity, and online lending, but it's always historically been it's been a laboratory for boiler rooms, fraudsters, hucksters. We're the largest state in the country, and we attract some of the best and the brightest here, but we also attract some of the crookedest people. And so we have people who may have a shop in Mississippi, online based, but then they're transmitting and operating within our state. The minimum contacts, that gets us our jurisdiction, but they're outside the scope of a lot of state activity, state control, and even federal control. It's like it's been described as whack-a-mole. In other words, you find somebody and you're about ready to close in on them, and then they're gone. They're here today, gone tomorrow. They pop up with a new website. And so they're very difficult to track whether they're in Belize or whether they're in Biloxi. They're very difficult to track, more so when they're offshore, granted. But they are, and that's why we have a number of different ways we deal with this, which I'll get into in a second.
Thank
I
you.
just wanted to ask Ms. Smith if she wanted to comment on the issue of the installment and the payday loans.
No, there is no difference whether they're out of the country or in the country, or the type of loan that, that's being offered. They all appear to be similar to a payday loan in terms of amount. But yes, they, when they're not licensed, they can ask for excessive fees. They have abusive collection practices and that type of thing.
So let me transition to a few other things we do. One is the basic consumer protection.
Let me ask you if I can.
Oh, I'm sorry.
No, that's okay, John. In my mind, I'm thinking to myself, abusive collection practices. So if you're payday loan, you don't have enough money to collect on the check, probably. I mean, once you don't pay the money back, you're not complying with the terms of the agreement. Give me an example of an abusive collection practice. You're not licensed in California, so you probably can't take them to the courthouse, but that's not the nature of this loan anyway. So what's an abusive, ruin my credit? What's abusive? Help me out. I'm trying to, in my mind, visualize.
They, well, obviously, it's strictly through your bank account. They continue to take out fees from the bank account through the ACH process. They, sell the payday lender will use a third-party company to continue to take out fees that will, so that and they will allow, unlike the California law where you're not allowed to.
You can't call
offer-
up the bank and say, hey, stop this, they're not a state of California, they're illegal, they're out of state, they're out of the country.
Well, we do, the consumers, have the ability to do that, but, look at the type of consumer that's taking out the payday loan. Are they gonna go to their bank and ask their bank, hey, please tell this company to stop taking out the ACH? A lot of times they don't even know where to go. We do get complaints like that, and what we have done as the department to assist these type of consumers is we, where we have the evidence and have done the investigation to determine that this is in fact an unlicensed online payday lender, we issue a desist and refrain order and provide that to the consumer, who can then take that to their bank. We have also, we can also contact the bank and provide them with the desist and refrain order in hopes to try to get the ACH, the unauthorized ACH debits to stop.
Thank you.
So,
I'm sorry, go ahead, John.
so in addition to the traditional enforcement action that we use, we think consumer information and protection is paramount as part of a multifaceted approach to deal with illegal online lending. There's no silver bullet, but with a multifaceted approach, we think we can deal with this problem. And so with consumer protection, we do alerts about unlicensed lenders, and most of these are online. These alerts, which are both in English and Spanish, are posted on the department website and publicized throughout the activities of the department's education and outreach staff. Many state legislators, for example, have consumer activities, conferences. We're usually there at those activities with this information. We go to schools, we go to businesses, we try to get that information out. That by itself is not enough because we're only reaching a certain amount, but it does help and it does get that information out. We're also partnering with other states' regulators on this problem through the Conference of State Bank Supervisors, CSBS, their Payday Lending Advisory Group. Now, we did a survey of state regulators earlier this year in August, and it indicated the common challenges. Everyone's facing this problem of unlicensed online payday lenders outside of their state or country. They're seeing abusive debt collection practices, third-party loan servicers, and unauthorized bank transfers. And I think our data showed that 95% of the states were taking some kind of activity against unlicensed online lenders. Now, in an effort to try to obtain information about payday lending not collected in the annual report, we did a survey to our licensed payday lenders in July 13 and talk about their borrowing needs and collection practices. So we got useful information for assessing the overall fiscal health and practices of the industry, which we're going to use to enhance in the examination process and regulations. These survey results are posted on the website, and it's important in this context because we think it's important if we have these companies who are licensed under California law, that if they're having difficulties, we want to work with them. If there are problems, if they are not complying with the law, we want to work with them, because by working with them, we're going to, I think, ensure that they don't, what we refer as, go south and decide to go bare or do online unlicensed. They see a cooperative but a firm regulator, and I think that's an important message to say. Now, an important development was on October 7th of this year. The department issued a letter to state chartered banks and credit unions advising them of the risk of banking unlicensed and illegal payday lenders and alerting them to the department's ongoing efforts to stop illegal unlicensed online payday lending activity. Now, what we did is we asked state chartered banks and credit unions to monitor the transaction with any unlicensed lender and report potential violations. The department will examine the state chartered banks and credit unions to ensure safeguards are in place to prevent unlicensed payday lenders from gaining access to the automated clearinghouse, the ACH network. By accepting debit and credit transactions from unlicensed payday lenders through the ACH network, financial institutions are knowingly or unknowingly enabling illegal payday loan transactions to occur in California. Now, the letter noted that to the extent a bank or a credit union conducts any business with unlicensed payday lenders, such activity could implicate safety and soundness concerns. Safety and soundness concerns. For example, a bank or a credit union may violate Bank Secrecy Act, the BSA Anti-Money Laundering Act requirements if its consumer due diligence procedures do not confirm a customer's compliance with state licensing requirements. A bank or a credit union must file a suspicious activity report to the Department of Treasury if it becomes aware that a customer is operating in violation of a state licensing requirement. Now, the department also noted that the FDIC, the Federal Deposit Insurance Corporation, had recently issued guidelines for banks on conducting proper risk assessments to ensure they are not facilitating illegal loans. The FDIC stated that their examination focus will assess whether banks are properly overseeing activities and appropriately managing and mitigating risks. So we have a dual banking system here, which provides for the chartering and supervision of banks and credit unions under both federal and state law. It's unique to the United States. In fact, we had a delegation from China recently that our department met with, and they were very interested because they have regional banks as well as national banks. but it's contributed to this country's economic advantage with thousands of institutions, large and small, serving the diverse needs of consumers and businesses in many types and states.
Mr. Hanna, since your October 7th letter, have you gotten any responses?
As a matter of fact,
Reports of violations?
well, it's, although it hasn't been a long time, we think a lot of the financial institutions are kind of digesting this, looking at it. We received an inquiry, actually we were notified last week by a credit union of a company that they believe is illegal online that had changed their name after this information, trying to, again, it's the whack-a-mole type of process. So that information has gone to Ms. Smith, and that is cases under investigation. We don't comment on cases under investigation, but I think I can respond to your question in that way. We have gotten one response. We're looking forward to others. We intend to have a lot of communications. We met with, I think there was representatives of about 25 banks with the California Bankers Association. We talked about this issue among many other issues. Nothing but support, and no real questions came up of concern about that. So every state charter bank must maintain deposit insurance through the FDIC and is subject to their guidance and regulations. The FDIC recently proposed guidelines on safe and sound banking practices and consumer protection in connection with deposit advance credit products, one of them I just mentioned. And this is a small dollar short-term loan that a depository institution makes available to customers when deposit account reflects reoccurring direct deposits. Now, the customer is allowed to take out a loan, which is to be repaid from proceeds of the next deposit that's made. These loans, similar to payday loans, typically have high fees, very short lump sum repayment terms, and often are made regardless of the customer's ability to repay the loan and meet other obligations. So what the FDIC's done now is their guidance would require the banks that offer deposit advance products to establish appropriate underwriting criteria to evaluate a borrower's ability to repay and to prevent churning or repeated borrowing to pay off a previous advance and prolonged use of the product. Such criteria should include the length of a customer's deposit relationship with the bank, the condition of other credit a customer may have with the institution, the customer's financial capacity, a cooling off period of at least 1 monthly payment cycle, established credit limits, and ongoing customer eligibility. Now, the reason we bring this up, and perhaps very germane to today, is you heard some financial products offered with no underwriting, others with some, others talking for the need for federal licensing. But here's an example of what the FDIC is looking at, and they are kind of, I think, adding a consumer-friendly and a stronger regulatory tone to this particular product that's being offered at the federal level. Since the department's banking license, our state licensed, our licensees must follow the FDIC's guidance, our department doesn't anticipate issuing our own guidance in this matter. But we would look at the licensee's compliance with the FDIC's regulations when we do our examinations. So, thank you for having us here. If there's any questions you have for all of us, and again, particularly in the banking area, Mr. Cameron could be helpful in answering those.
Thank you very much. I don't have any questions, but I want to thank you for being here today. And same offer I made the other folks here is that please contact us at any time. Any further comments? There's a lot of stuff that we're going to be digesting in terms of possible legislative solutions and how we can help you better enforce the laws of the good state of California.
We appreciate that, Senator.
Thank you very much.
We appreciate your leadership.
Thank you, Mr. Hanna. See you in Orange County.
Thanks.
Now it's that important moment that we open up the committee hearing for public testimony. If anybody would like to come up and share some of their comments, thoughts, recommendations, please come up. It's a resounding response. Going once. Yay.
Good morning, Senator Correa, Eileen. Thank you so much for the opportunity to speak. My name is Liana Molina. I came here this morning from the Bay Area. I work with an organization called the California Reinvestment Coalition. We're a statewide financial justice organization based in San Francisco. We have over 300 members all throughout California. A number of our members are CDFIs, community development financial institutions. We work with a number of small business lenders, small business intermediaries, technical assistance providers, as well as folks in the asset building community and financial education providers, et cetera. We have focused quite a bit in our work on CRA advocacy and urging banks to provide these kinds of loans and products themselves to consumers, as well as to invest in programs like we've heard of today. The Opportunity Fund is one example, MAF, through their philanthropic activities and otherwise. I'm also part of a coalition down in Santa Clara County called CAP, the Coalition Against Payday Predators. And in our work, we've done a lot of advocacy around the payday lending issue and for reform, but also delving deeper into this issue of alternatives, right? If we're trying to get rid of these predatory loans, what will serve the needs of the community? And we've had some success in convening nonprofits there in Silicon Valley, as well as credit unions. But it's a very difficult question, and so I do appreciate your leadership and the committee in hearing and having this hearing and learning more about what the options are out there. A couple points that I wanted to make is that regardless of what the products or the services or the programs are out there, we do believe that there needs to be some strong underwriting to ascertain whether or not the consumer has the ability to repay, because if they're not able to repay given their income and the other expenses that they have, it doesn't matter what we're trying to provide them, it's not a solution, right? We really need to help people understand kind of the having money to pay your bills and things of that nature. With regard to the emergency assistance, I think the products that were presented on here today, some of them, in particular, the payday lending is often used for that purpose. However, we know from data that exists that often creates a bigger debt cycle for people. So to your question with regard to how to help responsible lenders be able to scale up and provide these products, that would certainly be one thing that the Senate and the Assembly can do, is level the playing field for these lenders who cannot currently compete with the payday loan industry for the reasons that others mentioned. I think Steve touched on it, maybe Amy touched on it a little bit. I also just wanted to say with regard to the online piece that we do have, while we can see the upshot of regulating this, there are a lot of concerns simply for the fact that the internet is very big and it's hard to kind of regulate the bad actors. So even though the Online Lenders Alliance has 150 members, there's upwards of thousands of online lenders. So I think we need to be very careful in how we approach that. And we certainly look forward to working with you all over the course of the next year and years on finding solutions. So thank you for your time.
And thank you for your public comments. They're well received, and there was a lot of good testimony given here today. And a lot of excellent solutions. I agree with you. The internet is a big place. And I mentioned in passing online poker, which is totally illegal to play online poker, but yet something like 60% of all the online poker players in the good nation of the United States are from California. And I don't see a way that we can stop that from happening. And so we have our challenges in terms of smart, effective regulation, consumer protection, and at the same time, like has been stated a number of times here today, we want to provide folks with access to capital. And unfortunately, the folks that are having the hardest time are those folks that are socioeconomically having challenges in this great country. I've heard a lot of interesting comments today about how to get there, and we'll be working on them. I think the state is not in the business of making loans, but we're in the business of coming up with a regulatory scheme, hopefully that will increase the opportunities for folks to be able to access capital that they need, not only to survive on a day-to-day basis, but really to grow and prosper. And that's where we're going to try to go. Anybody else interested in commenting publicly? Doesn't cost you anything. Welcome.
Mr. Chairman, Paul Leonard from the Center for
Welcome
Responsible
again, Mr.
Lending.
Leonard.
Thank you very much. I just wanted to observe the effort that this committee and this legislature has gone to create its laws around the lending activities, and to have the Online Lenders Alliance come before you acknowledging that many of their members are not complying with California law in adhering to the licensing requirements and continuing to issue these loans seems to me to be deeply problematic. The evidence that we have from the Pew Research Institute suggests that the loan terms are, in fact, substantially more expensive than the loans that are allowed by the California laws. To my recollection, we've now gone through two processes of trying to modify the finance lenders law with a small dollar pilot program. And during that entire process, I don't recall a single time in which representatives of the Online Lenders Alliance or others came and testified and participated in the process to try and create the modifications that were being considered under that pilot product. Moreover, two of the licensees that are participating in the pilot program are in fact simply online lenders. And so I think it is critically important that we have a structure that says we're going to have one set of laws that will be enforced and protect consumers for all the lending activity that is required under California laws, and want to really commend the Department of Corporations for their efforts to educate consumers, to use the levers that they have at their disposal through their cease and desist orders, through their communication with their regulated entities, to try and make sure that they're doing everything they can to drive all of the lenders into the system that we have here in California that is required under law for lending entities to be licensed under law. Thank you.
Thank you very much for those strong comments. Responding to those comments, I just want to say that definitely our goal is to have compliance with the California laws, and with the ultimate goal of assuring, again, access to capital for those that need capital. And so as we move ahead and we look at how to get more folks to comply with the laws, the twin goal would be how to make sure people are having access aligned to access the capital they need. I look back at the comments made by Mr. Steve Zuckerman about that individual who got a payday loan as opposed to waiting for a few days to get the other loan, and trying to figure out how do you make it appealing for that individual to get an installment loan. Good questions, good stuff, good work that needs to be followed up on. More public comments? Welcome.
Hi, I'm a little shorter. Graciela Aponte. My background is actually in housing counseling. I started.
Welcome, Ms. Aponte.
Thank you very much. Back in Prince George's County, Maryland, where predatory lending was very prevalent, and I'm comparing this just to the mortgage predatory lending. After doing housing counseling for many years and fighting that through the predatory lending crisis, I moved on to National Council of La Raza, where I worked for 5 years, helping during the Dodd-Frank implementation and really fighting to strengthen some of these laws. And this reminds me of that a lot when I was doing housing counseling and providing really good products. Bank of America had a really amazing product for people who were low to moderate income. They had to take housing counseling courses. They were offered a really low interest rate, no mortgage insurance. And at the same time, you could go down the street and get a really, a fast loan, right? You could get a loan, it would be a really high interest rate, a lot of points. And so as I counseled thousands of clients, I would hear, I would recommend, hey, can you wait 6 months as we repair these certain things in your credit score to allow you to access this great product that, for example, Bank of America is providing. And I would successfully convince some of the folks, and many others would say, you know what, this house, I really want it, it's on the market, I'm gonna get it. And I could see very clearly that that was not a good product for them, that they would not be able to continue the payments once that interest rate adjusted for them.
Yeah.
So it reminds me a lot of that, where yes, we do want to increase access to the families that are struggling in these emergencies, but at the same time, we want to make sure that we're regulating and making sure that those bad products are not available to them, and not allowing them to see the great products that are already out there. So I just wanted to sort of make that comparison. It kind of reminds me of that a little bit.
Thank you.
Thank you.
Good morning. My name is Dan Gwaltney. I'm the Vice President of the California Financial Service Providers. And
Welcome, Mr. Gwaltney.
Thank you, sir. After listening to today's hearing, a couple comments came to mind. I think what the hearing has made evident is that there's growing demand. There's definitely a demand for small dollar, short-term lending here in California. And we're seeing various opportunities by some companies and nonprofits and financial institutions to try to solve that need. I know under the pilot programs that were drafted for installment lending, there's been an opportunity or a desire to try to solve that need. But I think as we sit back and we really look at the numbers of the various organizations that are attempting to do it, and I think there are wonderful opportunities there. Unfortunately, it's on the side of the problem. There is a major gap in the CFL law, and many of our members are licensed under the CFL and would like to fill this gap. I mean, under $2,500 right now, there's very little lending going on, as we know. Under the pilot program, there's just a handful of lenders, and what we've heard today is that attempts to try to solve this issue, unfortunately, come up unprofitable. And so I think that the policymakers here
Why?
in California have an
Why?
opportunity. Yes, sir.
Why are they unprofitable?
The rates, quite frankly, the economic structure of some of the things we've heard are leading to loss rates that are unsustainable for those organizations. And I think that if state laws change to allow for more further innovation and additional access
Define
to products,
higher innovation, higher rates of return, more fees.
Unfortunately, some of under the current CFL law, the fees are too low. Quite frankly, we need to be able to change the law to allow for greater access for more lenders. I mean, there's 4,300 licensed CFL lenders, but the number of loans done under $2,500 in the most recent report that we have were only 276,000 loans. So there's only a handful of lenders that are doing it, and there may be opportunities, and we'd like to work with the Senate and the Assembly to try to find ways of granting additional access for credit for California consumers. Thank you.
You know, your comments, I think, are very interesting because, again, you're looking at a spectrum of where do you go to start off to, build your credit so you can move and get that low interest rate loan eventually in your life. And that midpoint area, you talk about 2,500, may be the sweet spot that's causing the problem of going from under 200, under 500 to higher ups. And if your argument is it's not profitable, and I heard testimony today to the fact that it is not profitable, how do you come up with a scheme to make it profitable for folks to make those loans? Now, the assumption could be higher interest rates, but is that at a place where you stay and you get that loan and you pay it off and you move to a different level of credit? Or is this the place where you'll be staying? And is it wise for the legislature to, I guess, raise the interest rate limits that you can charge? And I want to explore that question a bit further because, again, as I close my eyes and I think about me going to my local supermarket, and as I'm paying for my groceries, I see a line of folks, or I don't see a line of folks, trying to get those loans. The question is, from a public policy perspective, do you want to increase the number of those storefronts to make those loans to those folks? I think we do.
And, Mr. Chairman, I think what we also heard today is that there is demand being satisfied by people who are not licensed in California, who do not pay taxes in California, do not employ people in California. And a lot of that demand is going offshore to people that policymakers can't regulate. And we noticed that filling that gap, I'll speak for my own company. I also represent a company. We're based out of Orange County. We have locations, and we're a CFL lender in Orange County.
What's the name of your company?
Payday Money Centers. And we're in Orange County, San Diego County, LA County, and Riverside County. And we've been licensed since 1999, and we have yet to make a loan under $2,500. We can't make the math work. So I think you're right, Mr. Chairman, there's opportunities so that consumers don't have to leave California and go looking for loans because they cannot get what they want under the existing California law. Thank you.
Thank you very much. Very good public comments. Anybody else? Please, no charge. Seeing no further comments from folks in the public, again, I want to thank all of our panelists that some have traveled from very far places to come in and to give their opinions. I look forward to continuing working with you and making sure we come up with a set of legislative proposals to help folks in the state of California access credit and capital. Seeing no further comments, this informational hearing is now adjourned. Thank you very much.